Hello, everybody. Welcome to this special English powered batch for CA Final Direct Taxes and International Taxation. Hope you all are doing really well. I'll be waiting for 10 seconds just for all of you to stay at your position and let us analyze what we have done till now. We have started with chapter capital gain. Day before yesterday, we were done with definition portion and a portion of computation part. Yesterday we did special cases, all the special cases that were exceptions to section 45(1), and also we did special cases part 2, which included ULIP, which also included slum sale or any of the transfer that partnership firm does to partners, any kind of advance money forfeited or any kind of other special tax capital gain that used to accrue in your books has already been covered in yesterday's lecture. We had also completed exemptions in capital gain and also all the tax rates that are prevalent for your syllabus. We had already started with exempt income, exempt transfer, and we are about to finish it today itself. So let us jump to the topic. Let us first revise what exempt transfers, what we have studied till yesterday. First of all, first of the exempt transfer was in case of any partial or complete partition of HUF. Any asset transferred from the HUF to the members will be completely exempt on account of partial or complete partition. Second exempt transfer we studied was on account of gift, any asset is given to somebody, then it will be exempt transfer. Third exempt transfer we studied when a company transfers any capital asset to its 100% Indian subsidiary, then such transfer will be exempt transfer, but there were two conditions associated with that. First condition was, sir, such 100% parent subsidiary relationship shall subsist at least for 8 years from the end of the year in which transfer took place. And second thing, that subsidiary company or the transferee entity shall not convert such capital asset into stock in trade. These were two basic conditions. If any of these conditions got violated, then such transfer shall be taxable in the year in which violation took place. Then we had transfer and the amalgamation. Any asset transferred by amalgamating company to amalgamated company will be exempt transfer. If a shareholders whose rights are extinguished in the amalgamating company for receiving shares of amalgamated company will also be exempt. For example, any shares of Indian company are being held by foreign company and that foreign company amalgamates with another foreign company, then any change in shareholding will also be exempt. And in case of transfer of capital asset between banking companies or banking institutions, as per the RBI guidelines or Banking Regulation Act, it will be exempt transfer. Later on, we studied about transfer in case of demerger. When any company gets demerges from its resulting company or its parent company, then any asset transferred from demerged company to resulting company will amount to exempt transfer. Any surrender value of the shares by the shareholders in demerged company and getting shares of resulting company in return will also be exempt transfer. And if any shares of Indian company are held by a foreign company and such foreign company does a kind of demerger and shares of such Indian companies are being transferred to such resulting company in that demerger, that transfer will also be exempt transfer. Later on we studied about exemption in case of sovereign gold bonds. Every redemption of sovereign gold bonds for an individual SSC will be an exempt transfer. What if sir, redemption is done by any SSC other than individual, then it will be taxable, but capital gain would apply after indexation. Sir, what if we earn interest? Then what will happen? Interest will be taxable as per normal tax rate. What if sir, individual does not redeem it transfers before such redemption? What will happen? Then capital gain will be applicable in the hands of individual, but he will get the benefit of indexation if asset is long term. Sir, what if sir, house is transferred under reverse mortgage scheme? It will be exempt. From next point onwards, we have to start from today. Hope you remember what we had studied yesterday. Sir, under the agreement of SEBI guidelines, any shares transferred under stock lending scheme will be exempt. What does that mean, sir? For example, I want shares. For example, I want shares. I am aware of the fact that market is going to fall tomorrow and Reliance will fall the most. I am aware of this fact that Reliance will fall the most. What will I do? I can short sell such shares. Can I say I can short such shares? Right answer is yes, I can short such shares. But I want to carry my position for longer duration. So short selling is not allowed in Indian market for more than 1 day. If you want to short that position, you can do that by getting stocks lent from somebody. You can ask your friend to lend you some stocks and you can sell them. And as soon as the price goes, you can buy them again. You can earn profit by selling them first and buying them again. In that case, any service provided by your friend Any transfer of asset made by your friend to you on account of stock lending scheme will be completely exempt. Just listen to example. For example, Rahul is the one who wants shares. He asked Mayank to give him shares of Reliance. So Mayank gave shares of Reliance. For example, price was 3,000. Rahul shorted it, short sell. Rahul did a short sell for 3,000 and bought at 2,800. Rahul made a profit of 200. Now, can I say transfer made by Mayank to Rahul will be also considered as transfer because Mayank relinquished his rights in shares? Can I say Mayank relinquished his rights in shares? So, can I say transfer made by Mayank to Rahul will also be exempt transfer? Right answer is it will be exempt transfer. But for transfer, it will be transfer, but it will be exempt transfer because it is on account of stock lending scheme and as per the guidelines of the SEBI. Therefore, any transfer made under stock lending scheme will also be exempt transfer. Next one. Sir, if you transfer any work of art, or any archaeological collection or any manuscript or any kind of photograph book to a national library, to any government, to any university, to any museum or to any art gallery, then it will be completely exempt. For example, Leonardo da Vinci, if you know this name, the person who created Mona Lisa, I was very much inspired by them. I was very much inspired by him. I created a painting called Sona Lisa. And it got so popularized on the internet that everybody was willing to buy a copy of it. Everybody was willing to buy a copy of it. The original copy of this painting was worth billions of dollars. I thought, why not to do some government public service? I donated this painting of Sona Lisa to art gallery. So any transfer made by me, even if this painting was worth $100 billion, then to any transfer made by me to such art gallery will be exempt transfer. You can leave this point for some time, or we can study this. Just focus here. I want your focus here. If we are very much familiar with concept of business trust. Business trust holds at least greater than 50% in SPV. SPV is nothing but a company, Indian company. Business trust is nothing but REIT or InvIT. Business trust holds at least 50% in SPV. To make it SPV, of course, it is very natural. To make it SPV, at least it should hold more than 50%. Can I say rest 49% or less is being held by somebody else? This means rest is held by somebody else. Rest is held by somebody else. Yes, sir, rest is held by somebody else. It is very much apparent from C. What if business trust, for example, rest is held by Rahul. Rahul holds a balance 49%. Now business trust wants to acquire shares of such SPV from Mr. Rahul. Business trust want to acquire such shares of SPV from Mr. Rahul. And what business trust promises in return? Business trust promises to issue units of business trust. What business trust has said? Give me shares of such SPV, Rahul. Rahul, just give me shares of such SPV and I will issue my units to you. Can I say there is transfer on account of Rahul? There is transfer occurring in the hands of Rahul. He is foregoing shares of company and receiving shares of units of business trust. He is foregoing shares of company and receiving units of business trust. Any capital gain arising in the hands of the transfer on account of transferring shares of SPV to business trust and getting units will be exempt transfer on account of Rahul. What this provision says? Transfer of SPV, transfer of shares of SPV in exchange of units of business trust will be an exempt transfer. So transfer of capital asset by predecessor cooperative bank into successor cooperative bank. For example, there is cooperative bank reorganization. Any transfer of capital asset by one of the cooperative bank to successive cooperative bank will be exempt transfer. No rocket science in that. If any Indian Infra Finance Company Limited transfers any capital asset to institution established for financing, then it will be exempt transfer. Not too much to learn. If any public sector company transfers capital assets to another public sector company under the plan approved by the central government, it will also be exempt transfer. Normally, whatever central government approves, it will be exempt transfer only. So a public sector company transferring capital assets to public sector company under plan approved by CG. For example, BHEL merges with SAIL. So any transfer of capital asset will be exempt transfer in that sense. Transfer of shares by the shareholders in case of business reorganization if consideration is allotment in the shares of the successive cooperative bank. For example, there is a bank called Vijaya Bank. There must be some shareholders in this bank. Yes, sir. Every company has a shareholders. Now this Vijaya Bank got merged in Union Bank. Union Bank. Instead, now shareholders of Vijaya Bank are getting shares of Union Bank against the shareholdings in Vijaya Bank. Shareholders of this Vijaya Bank are getting shares of Union Bank against their shareholding that they had in Vijaya Bank. This provision says transfer of shares by shareholders in banking business reorganization if consideration is in the allotment of the successive cooperative bank or banking company. As simple as it can be, any transfer by the shareholders in the business reorganization if consideration is in the allotment of the successive cooperative bank or banking company. Transfer by such shareholders of such Vijaya Bank shares will be exempt transfer if he receives the shares of Union Bank. Mutual fund related exempt transfers. Just focus here what I am saying. Rahul has equity oriented mutual fund of Kotak and equity oriented mutual fund of Canara Bank. NAV 200 rupees, units 1000, NAV 100, units 1000. Now what if Kotak equity oriented mutual fund merges with Canara Bank? Or I should simply say, to make it a bit more simpler, Kotak classic fund, equity oriented, Kotak delight fund, equity oriented. Now if Kotak wants to discontinue any of the fund and merge them, Kotak wants to discontinue any of the fund and wants to merge these two funds. They created a new fund named Kotak Elite Fund, equity oriented. They got some synergy of benefits. They got some synergy of benefits. For that matter, their NAV turns out to be 350, and any unit holder shall holding both the units will get 1000 units. Now, what if Rahul was holding 200 units of 1000 each? That means he was holding units worth rupees 2 lakh. Now, and he was holding units of rupees 1 lakh. Now, in case of this merger, Rahul got a gain of rupees 50,000. Can I say Rahul got a gain of rupees 50,000 because in merging two mutual funds, there was benefit of synergy. In merging these two mutual funds, there was benefit of synergy. Therefore, capital gain was there was some capital gain arising in hands of Mr. Rahul. Can I say that? Right answer is yes. Capital gain do arise. In that matter, no capital gain will be calculated in the hands of Mr. Rahul. Capital gain will be exempt under section 47. Why capital gain is exempt? Because this capital gain is not on account of Rahul's will. It is done by the company. Company can merge any mutual fund at any time. What can Rahul do? Is he only there to pay taxes? No, right answer is no. When Rahul will be selling such mutual fund units, then only tax will be levied in his hands. Merging by companies into different plans or merging two mutual funds will not accrue any kind of capital gain in the hands of Mr. Rahul. But there has to be a certain condition. What condition, sir? Only equity oriented mutual fund shall merge with equity oriented mutual fund, and or I should say debt oriented mutual fund shall merge with debt oriented mutual fund. This should not be case that equity merges with debt. No, this should not be case. Equity should merge with equity and debt should merge with debt oriented mutual funds. This is one part of the mutual fund exemption scenario. Let's understand second part. For example, Kotak has dividend plan. Rahul again has rupees 200 NAV. units 1000. Kotak has reinvestment plan. Again, Rahul has 100 NAV worth NAV, units 1000. Again, now Kotak want to merge these two plans. These are not two different mutual funds. These are two different plans. When there is consolidation of two plans in a mutual fund, then any capital gain arising on such consolidation will also be exempt. For Rahul, what is happening? If he is getting mutual units of different fund, there is extinguishment of rights in these units. Ideally, this should amount to transfer, but this is not a transfer. This is an exempt transfer. If you can ideally see the situation, what Rahul is getting unit of Elite Mutual Fund, Kotak Elite Mutual Fund. But for receiving Kotak Elite Mutual Fund, he is foregoing the units of Classic Fund or Delight Fund. For that matter, transfer should take place on his account. In that case, transfer is considered to be as an exempt transfer. There will be no transfer in his hands. Got this point? Yes, sir, we did understand. Just read along with me what it says. In mutual fund related exempt transfer, in consolidation of mutual fund, when two equity oriented mutual funds or two debt oriented mutual funds consolidate with each other, same class, equity to equity and debt to debt, then transfer of units of previously held class will be exempt. For example, Rahul is foregoing units of Delight Mutual Fund to receive the Elite Mutual Fund. He is foregoing Delight to receive Elite. So for that matter, any foregone asset to receive new asset on such account, exempt transfer will be exempt. For example, 1000 units bought for rupees 90 in each in case of Nippon Equity Classic Fund. On 1st April 2023, Nippon Classic merged with Nippon Growth Fund and received 1200 units. This shall not amount to transfer. Now, any sale of further Nippon Equity Growth Fund shall amount to transfer, and period of holding will be considered from 1st April 2024 only. Did you get this point or not? If there is within same class of mutual fund, there is consolidation of any plan, for example, dividend plan merged with growth plan, then it shall also not amount to transfer. This is the basic bottom line in case of mutual fund related exempt transfers. Okay, sir. Okay, sir. We did get you what you are saying. Conversion of entities. It's a sole proprietor, partnership firm converted into company. Sole proprietor gets converted into company. Yes, he can do so. Partnership firm gets converted into company. Can he do so? Yes, sir. Or any association of person converts into recognized stock exchange. Is it possible? Right answer is yes. National Stock Exchange today is a company, but previously it was association of person. There was corporatization of stock exchange from AOP to company. In that case, it is an exempt transfer. How transfer is exempt? What conditions to be complied? We have to study here. Here are the conditions. Whenever a sole proprietor converts into company, or a firm converts into company, or AOP converts into recognized stock exchange or a company, then in that case, all assets, liabilities of the all the assets and liabilities of the entity are to be transferred. All the assets of the sole proprietor are to be transferred to company. All the assets of the partnership firm are to be transferred to company. And in return, he should get the shares of the company. There should be no consideration paid by the company. He should be receiving the shares of the company. For example, I am the sole proprietor. I should get all the shares of the company. If I am the partner, if I am partner in a partnership firm, I should receive the shares in the company. I should not receive any else compensation. Also, there is another condition that shareholding of previous proprietor or member should not be less than 50% within 5 years from the date of the conversion. It puts a condition to sell off any shares in such company. In such converted company, it puts a condition. What it says: as soon as sole proprietor gets converted into company, shareholding shall be at least 50% by such partners or such sole proprietor for at least 5 years. It puts a restriction on you all, so that it puts a restriction on the partners so that they should not leave the company by merely selling their shareholding. It puts a condition on them to hold them in the company, and it says at least all partners shall have at least minimum 50% of the shareholding continued for next 5 years, or that proprietor that has converted into company shall hold at least 50% of the shareholding at least for 5 years from the date of the conversion. Also, Sole proprietor shall become the only shareholder in the company. It's a simple case. If I am the owner of all the assets in my business, I should be the shareholder. I should be the only shareholder in the company at the time of conversion. Sole proprietor shall be the only shareholders. And for partnership firm or AOP, partners and members shall be allotted shares of the company in the proportion of the share capital on the date of the conversion. Sir, conversion at the time of conversion, whatever be the share capital of the partnership firm, shall be the similar ratio in terms of share capital in the converted company. What it means, for example, A, B, C are three partners having out share capital of 20 lakh, 30 lakh, and 40 lakh. 40 or say 50 lakh. When these ABC converts into ABC Private Limited, now shareholding shall be on the basis of their partner's capital outstanding as on the date of the conversion. There shall not be any other basis of shareholding. Basis has to be the partner's capital account on the date of the conversion. Did you get this point or not? Also, corporatization of recognized stock exchange shall be in accordance with the guidelines issued by the SEBI. So it is as simple as it can be. If you are creating a stock exchange or if you are creating a stock exchange, so you have to follow the guidelines as per SEBI. This is the basic condition. All these conditions to be fulfilled. Once fulfilled, then exempt, then transfer will be exempt transfer. Conversion of such proprietor into company will be an exempt transfer. Sir, what if an unlisted company wants to convert into LLP? Can it convert? Can it do so? Can it do so? Sir, first of all, it has to comply with two conditions to get converted, and it has to comply other four conditions to remain exempted from tax. What two conditions to comply? It says total turnover or gross receipts of the company shall be lesser than 60 lakh rupees in last 3 financial year from the date of the conversion. From the date of the conversion for last 3 financial year, the turnover shall not be more than 60 lakh rupees in any financial year for such unlisted company. Second thing, total assets of the company shall be up to 5 crore in last 3 preceding financial year till the date of this from the date of the conversion. That means from the date of the conversion for last 3 financial years, total assets shall not exceed 5 crore in value. If these two conditions are complied, then that unlisted company is eligible to get converted. And once such company is converted, then any transfer arising on such conversion shall be exempt if these 5 conditions are fulfilled. What are those 5 conditions? First condition says all assets and liabilities are to be transferred to LLP. As simple as it can be, all assets of the partnership, all assets of the company shall be transferred to LLP. Second thing, all shareholders shall become partners and their capital contribution and in PSR shall be in proportion to the shareholding. For example, I am a shareholder of 10%. I am holding 10% in the company. So at least 10% of the partner share capital shall be on my account, or 10% of the PSR should be on my account. So whatever my shareholding share was in the company, I should be entitled to that much amount of partners capital and PSR. Sir, consideration to shareholders. What consideration I will be getting against my shares in the company? See, I am having a company and that company is converted into LLP. So I am extinguishing my rights of shares. I am extinguishing my shares. I am getting my shares extinguished. So there is transfer on this account. I should be receiving something now. So what I am receiving, I should receive share in profit and capital. No else thing I should be receiving. I should be receiving only share in capital and profit and nothing else. Fourth condition is PSR of LLP of the shareholder shall be at least 50% up to the 5 years from the date of conversion. As soon as date of conversion is lapsed, at least 50% of the PSR shall be same. Those shareholders that were at the time of conversion, the partners in the LLP, shall continue to have at least 50% of the PSR till the end of the 5th year from the date of the conversion. And last point is very intelligent point. See, if you want to take money out of the company, you have to pay dividend. If you want to take money out of the company, you can pay dividend or it will be deemed a dividend. If you have reserves in company, if you want to take out, you have to pay the dividend. Now, there is no other way. Either it can be dividend, it can be deemed dividend. What if I convert this company into LLP and use this reserves from this balance sheet? Can I do that? There is restriction on such use. Provision says no amount should be paid directly or indirectly to the partners from accumulated reserve from standing on the date of the conversion. Whatever the accumulated reserve balance was on the date of the conversion can never be distributed to partners. Why, sir? If you want to distribute, pay tax on that. because for company it was not allowed to be distributed. So for LLP also you will not be allowed to get distributed. Very beautifully crafted provision. I want you all to read these points once again, and then we can proceed later on. I want you all guys to read it once again, so that we can proceed later. So that we can proceed further. If any condition is violated, then exemption claimed by proprietor, firm, and company will be taxable, and successor will be liable to pay the tax. For example, proprietor converts into company, violates any condition, company will be liable. If company converts into LLP, LLP violates, so LLP will be liable for taxes. Just give me a second. Got this? Perfect. Conversion of securities. If any debenture stocks, or any kind of deposits are being converted into shares of the same company, will it be exempt transfer or taxable transfer? It will be exempt transfer. If any preference shares are converted into shares of the same company, will it be exempt transfer, taxable transfer? It will be exempt transfer. Or if any physical gold is being converted to digital gold at gold vault, or such gold deposits, EGR, electronic gold receipts issued by vault manager, then it will be an exempt transfer. These are simple things. These are simple things. Conversion of securities. This has to be remembered that debentures, debenture stocks, and deposits converted into shares are exempt, and preference shares converted to shares of the same company are also exempt. Transfer in case of non-resident, I want you all to hold it for some time. I want you all to hold it for some time. We'll do it later on as soon as we are done with NR taxation. The few important cases to be discussed before solving any question. Let me check. Have I left anything till now? There were a few things to be discussed. I'll discuss them. Don't worry. Okay. In all the cases, see, whenever you receive an asset on account of exempt transfer, whenever you receive an asset, for example, somebody gifts you an asset, or you are a subsidiary company, you receive asset from your parent company. If you receive asset on account of exempt transfer, what will be cost of acquisition? We have already discussed. The cost of acquisition will be acquisition of the previous owner. Got it? Yes, sir. So for cost of acquisition, we are very much clear that cost of acquisition before such exempt transfer shall be cost of acquisition of the previous owner. We can say simply. What will be, sir, cost of improvement? Sir, cost of improvement done by me or done by the previous owner will also be considered for calculating capital gain. If I am receiving asset on account of exempt transfer, whatever improvement I am doing will also be considered, and whatever improvement previous owner has done will also be considered. Yes, sir. Sir, what period of holding to be considered for calculating it, whether it is long-term capital gain or short-term capital gain? Period of holding held by me will also be considered, and period of holding held by the previous owner will also be considered. Sir, is benefit of FMV under section 14/2000 benefit of FMV as on 1st April 2001 is applicable? Sir, for example, my father bought a property way back and he gifted me in previous year 2021. Then will benefit of FMV available? Right answer is yes, it will be available. The issue is with indexation. Sir, what type of issue is there? Sir, from when we'll index? For example, just listen. Previous year 0102, father bought 10 lakh. Previous year 7/8, gifted to son. Son sold on 31st March 2024. Gifting this property to son was exempt transfer. But when son sells such property, it will be taxable transfer. For example, son sells such property at rupees 60 lakhs. Computation of capital gain. Yeah, sales consideration will be 60 lakhs. Yes, for son it will be 60 lakhs. Cost of acquisition will be, what will be cost of acquisition, sir? Cost of acquisition of the previous owner, like my father. Sir, divided by CII of acquisition multiplied by CII of transfer. Sir, CII of transfer is 348. It is as simple as it can. So now issue is with indexation. Will it be CII of 7/8 in which I acquired this property, or will it be CII of the previous owner, that is 0102, in which my father acquired the property? What will be CII we will be using? I want all of you to answer this. I want all of you to answer this. What CII we will be using in this case? What CII we will be using? So whenever you are studying indexation, it is clearly mentioned. It is clearly mentioned when you are studying indexation. It is mentioned that cost of acquisition shall be indexed COA divided by year in which you have acquired the asset and multiply by year in which asset is transferred. In which year you have acquired the asset? You have acquired asset in previous year 7/8. But is it correct? Because you are considering cost of acquisition of your previous owner. You are considering period of holding of your previous owner. Why not indexation from the previous owner? Because my father actually bought it. No, I did not buy it. My father bought it. Why not indexation for previous year 1, 2? This was presented to Bombay High Court. And Bombay High Court said in Manjula Jesha's case law that indexation from previous year, from previous owner can be considered. This was verdict in case of Manjula Jesha case law. Now, there is fundamental issue in this point. In most of the question, ICI solves by taking previous year 7/8 for date of acquisition for indexation purpose. But it also gives an assumption, or it gives an alternative that question can be solved by considering this number as year of acquisition. It always gives this assumption that you can solve by considering index number of this year also. So from now onwards, you will be using this method. You will be using this because it is consistent. This year of CII is more consistent to solve in any question. If you consider this, you will get confused in most of the questions. So we don't require confusion at this point of time. Just take this CII and every question will be in the same tone. Your answers may not match by solving this, but there will be always an alternative given in the bottom of the answer, which will correct your, which will justify your thought process, which will state that your answer is also correct in that sense. So from now onwards, you will be using this. If you are in a habit of using this year as CII, do use it. And I don't want to confuse you. But if you are using this year for CII, make a habit. Remember this thing, that in case of indexation will be considered from previous owner, not from immediate owner. From previous owner, indexation will be considered. At this point, this was all about I have to tell. Now just let me have a look. What did we leave till now? What did we leave till now? I guess we are done with chapter. Only transfer related to NR taxation is pending. We will be doing it after non-resident taxation. I think where there were too many or 2 or 3 holds. Okay, here you go. This is one thing we held for later on. See what happens is, if I am buying a house for house is worth of 20 lakh. Out of the 20 lakh, 10 lakh I bring from home and 10 lakh from loan. For paying this 10 lakh loan, I have to pay at least 10 lakh of interest and nearly 10 lakh of 10 lakh interest and 10 lakh principal. Is it correct? Or I should increase this amount. Say for example, 30 lakh. No, not 30 lakh. It should be increased to 1 CR. 50 lakh, 50 lakh, 50 lakh interest, 50 lakh principal. This is the case scenario, correct? When I will be selling this selling this house. For example, I sold this house for 5 CR. Buying was made in 1st April 2010. Every year I am paying interest, I am paying principal. EMI stands out to be 7 lakh. EMI stands out to be 7 lakh. EMI for house is 7 lakh rupees. Sir, what is the case that I'm trying to say? What I'm trying to convey is, if when you are selling this house and considering capital gain, the sales consideration will be this. Cost of acquisition will be initial cost that you put in 50 lakhs simply divided by CII of acquisition and CII of transfer. This will be index cost of acquisition. This is a simple case. Sir, you will be also reducing amount paid for loan. Sir, you will be reducing the amount paid for principal. Previous year 10 11 7 lakh, 11 12 7 lakh, 12 13 7 lakh, 13 14 7 lakh. You will be indexing such principal amount and interest amount. You will be indexing such loan amount also, because that loan is also part of cost. That loan amount is also part of cost. So you will be indexing that cost of acquisition or improvement, as the case may be. Now with Finance Act 2023, Finance Act 2023, government made a amendment. What amendment it has made? Government knows how logically you are tax planning. Government knows that every year when you are considering deduction of this 3.5 lakh rupees, see, if 7 lakh is EMI, 3.5 lakh will be interest, 3.5 lakh will be interest. You must have claimed this interest in house property head. When you are computing income of previous year 10 11, you must have taken deduction of 3.5 lakh under house property under section 24B. Whenever you're considering income from house property, you take interest on loan paid for house property, you must have taken deduction of this amount. Or if not possible, you must have taken under section 80 EEA. You must have taken balance deduction in 80 EEA. Now again, you want deduction in this capital gain computation. Isn't it somewhere wrong? Isn't it somewhere wrong? Are you getting me what I'm trying to say? You have already taken deduction under the house property act for such interest on loan. Now you want again that loan to be reduced and at the time of cost of acquisition, and you want to index it also. You want to even index it. Right answer is what government said. You cannot reduce, you cannot take interest paid on such loan as cost of acquisition if that interest has already been claimed under deduction under chapter 6A or under section 24B. Now say for example, the 7 lakh EMI includes 3.5 lakh interest and 3.5 lakh rupees loan. Now suppose this is the legitimate bifurcation of this interest. If you have taken deduction of interest under section 24B or chapter 6A, then this interest will not be allowed to be added in cost of acquisition. This is the bottom line. So what I have to say, what bottom line, what I am putting is, if any interest is being paid for housing loan and deduction of such interest is already taken under section 24B house property or 80 is chapter 6A, then in that case such interest paid will not be allowed to be added in cost of acquisition at the time of selling such house. Got this point or not? Just read after me. See, it takes 10 minutes to explain such provisions, but it takes only one line to write this point. Cost of acquisition of housing house property shall not include interest when such deduction is already claimed under section 24B or chapter 6. If deduction for interest is already claimed under chapter 6A or 24B, then you cannot again add back it to cost of acquisition. This is what the provision says. Do we have anything left now? I think one provision was left. I think one was left. So we have covered this. This is also covered 1037. Yes, there you go. Tax saving tools. For example, you are doing any slum sale. You want to save tax, what can you do? See, what happens is, for example, a company is Mamarika. Mamarika wants to separate the retail division. Retail division they want to sell. They want to sell to Rahul Private Limited. Now, since if they will be doing slum sale, in that case, capital gain will arise in the hands of Mamarika. What can it do to avoid such capital gain? It can directly do a demerger of this retail division. Demerger is an exempt transfer. Demerger is an exempt transfer, and later on, this retail division can merge itself with Rahul Private Limited. It can also do so. Can it do so? Yes, sir, it can do so. Or it can do what it can do. Sir, Mamarika can acquire 100% shareholding of Rahul Private Limited and transfer such assets to Rahul Private Limited. Can it also do so? Because once a subsidiary is created, that to 100% subsidiary, then any transfer of capital asset to such subsidiary will be exempt now. So in that case, any such transfer will be exempt transfer. So these are tax saving tools. These are two tax saving tools that can help you out to reduce any taxes arising on account of slum sale. I held this topic for later on because I had not taught exempt transfer topic. Therefore, once it was done, I think it was the right time to teach these topics. The best one. I really enjoy teaching capital gain. But arriving to new chapter, that is income from other sources. Before starting this chapter, remind me what was the charging section in capital gain. What was the charging section in capital gain? Sir, under capital gain charging section was, sir, section 45. What was the charging section in house property? Sir, section 22. What was the charging section under salary? Sir, we don't remember. That was the topic of inter. We don't remember. Sir, section. 16 was the charging section of salary. Same for IFOS. Charging section is section 56. What charging section says? Any income that is not chargeable under the head salary, house property, PGBP or capital gain, which is not chargeable in any head and which is not exempt shall be taxable under the head IFOS. Very basic definition it states. That means all lots of income that are not taxable elsewhere will be taxed here. Can I say that? Yes, sir. It is the simple definition. Income, whenever is not taxable in any head, it will be taxable under that IFOS. But yet, IFOS provision provides for a list of series of transactions that will ever be taxable in IFOS chapter. Sir, what are those transactions? Sir, dividend, always taxable under the head IFOS. Always. If you are trading in securities, always dividend will be taxable under that IFOS. Sir, interest on securities, bank deposits, loan, IT refund. Interest of any kind will be taxable in the IFOS except for a few we have to study. Sir, interest on, sir, winnings from lottery. Winnings from lottery, if you are winning any lottery, sir, card game, which head it will be taxable? It can never be PGBP. Na? It has to be taxable here because no other head satisfies conditions that winning has. It has to be other source. Winning can never be a salary. Winning can never be income from house property. Winning can never be income from salary. Winning can never be income from business. Winning can never be from income from business. Therefore, it will be taxable under the head other sources. We will study about this in tax rates chapter. After PGBP, we will be studying about this. So, winning from online gaming, whatever gaming that people these days have from MPL or Dream 11. Remember, whenever we play Dream 11, we deposit ₹100 and we make a team of 11 cricketers. And if that team is the dream team, we win 1 crore rupees. That online gaming is also taxable, and we'll study that in we'll study that in tax rate chapters. Income from letting out of plant and machinery will be taxable to the head IFOS. Sir, why IFOS? Why IFOS? So simple, because house property you cannot have. The house property is house property. Plant and machinery is not house property, so not in the house property. Income from plant and machinery from in capital gain, no interest is chargeable in capital gain. Income from house property and the salary. Oh my God. Income from PGPP. Can a plant and machinery income be in PGPP? Right answer is yes. If your business is renting out of plant and machinery, then it will be taxable under PGPP. Otherwise, it will be house property. Otherwise, it will be other sources. Sir, amount of income received under Keyman insurance policy. What this says, sir, any amount received on Keyman insurance policy, normally it is taxable under the head PGPP. But if not taxable under PGPP, it will be taxable here. Sir, interest received on compulsory acquisition of land. Sir, if your land is compulsorily acquired and you receive compensation against that, and that compensation is delayed, so you get interest on that also. You get interest on that, and that interest will be taxable under the head other sources. We have studied this in capital gain. Sir, any advance money forfeited after 1st 4 2014, that is after Modi government coming into power, any advance money forfeited will be taxable under that IFOS. We have studied this in capital gain chapter. Sir, taxability of gift, if you are receiving any gift, will be taxable under the head IFOS. We will study about this later on. Any family pension that you are receiving, family pension after the death of the SSC, whatever family pension will be received will be taxable under the other sources. How taxability arises, we'll study. Salary of MP MLA. See, salary of MP MLA will never be taxable under the head salary. Why, sir? Why not salary? Sir, because they are not doing any employment now. They are not doing any employment. They are providing service to general public. We call it seva. We call it seva. They are doing seva to general public. It is a volunteering work. It is not an employment. It is not a professional service. It is an act of volunteering. So for that matter, their salary will be taxable under the head IFOS. And two things to be taken care of is daily allowance and constituency allowances are always exempt. Whenever they receive daily allowance or constituency allowance, it will be exempt in their hands. Sir, any undisclosed income? Sir, for example, there is entry in my account. Okay, we'll study about this undisclosed income. For example, I have a house in Juhu. I have a house in Bangalore and I have not disclosed such house to income tax authorities. How will that house be taxable? That house will be taxable under the head IFOS. We will study about this in miscellaneous topics. Sir, amount received under angel tax. Angel tax, what angel tax is? For example, if shares of unlisted company are issued way more than fair market value. See, issue price is 10,000, but fair market value of such shares is just 1,000 rupees. Then whatever extra amount that you are receiving will be taxable under the head angel tax. Sir, although this topic is being reduced with effect from next financial year, next Finance Act, it is removed. But for your exam, it is equally relevant because the previous year or the Finance Act applicable for your exam has still this topic in it. ICAI has not changed this topic. Therefore, you have to study this angel tax for your attempt. Okay, you cannot consider leaving this topic. This is really very important. So, director sitting fees. Director sitting fees, if he is a part-time director, it is not his business to sit in the office, then it will be taxable under PGBP. Sir, compensation on termination of the employment. Sir, what happened? What happened, sir? What happened here was, I was teaching so well. That Allen Career Institute, Kota, asked me to be their DT professor for CA course. Getting me? What a great opportunity. Allen Career Institute in itself asked me to teach DT at Allen. How can I refuse this opportunity? How can I refuse this opportunity? I did go. Now, for that matter, Sarthak sir asks me to pay 5 lakh rupees as compensation because I am leaving their job. Allen pays me such 5 lakh rupees and even 10 lakh rupees more to leave this job at FAST. Which implies Allen pays me nearly 15 lakh rupees for me to leave job at FAST. Any income received on account of termination of employment from a person other than employer. Here in case, Allen is not our employer. Any compensation received from a person other than employer will be taxable under the head other source. What if Sarthak sir pays me money to leave this job? Sarthak sir says, you teach DT so beautifully that people want to study FR from you too. Sarthak sir complained to me that you teach so beautifully that people also want to study FR from you. So for that matter, he paid me 5 lakh rupees and asked me to leave teaching. In that case, if an employer pays If an employer pays any kind of compensation for termination of employment, it will be taxable under that salary. But if it is being paid by somebody else, then it will be taxable under that IFOS. I hope you understood what I am trying to say. And last one is any income that is not taxable elsewhere will be taxable under IFOS. So why this blue, why this red, why these two marks have been made in this book? See, this blue are the blue ones are the topics that we have to study detail again. These are not just, these were the briefings about these topics, but these blue ones we have to study again. But these red ones are either studied because there is no depth in this topic. For example, in compensation on termination of employee, there is no depth in this. Any compensation received will be taxable in my hand and the other sources. There is no depth in this topic. Only this much is sufficient for you. So whatever is given in this red point, either it is sufficient or either it is covered in any other chapter. Therefore, I have marked red in this. But whatever the points that are covered in blue are to be studied in depth. So I have to proceed to that topic also. Right away, starting from taxation of dividends. Sir, how dividend is taxed? First of all, sir, there are three kinds of dividend. First of all, sir, final dividend, sir, taxable in the year in which it is declared, not in the year of payment. Sir, in the year of declaration, it will be taxable. Sir, interim dividend, taxable in the year in which shareholders receive it. Or deemed dividend, the period in which company pays such deemed dividend, it will be taxable in the year in which it is paid or it is distributed. These are the three kinds of dividends. Sir, what is deemed dividend? Sir, how it is taxable? First of all, you need to understand that dividend is taxable for shareholders and it is exempt for the companies. No tax has to be deducted by the company on dividend. It has to be exempt in the hands of the company and it will be taxable in the hands of the shareholder. Sir, what is deemed dividend? Brief it. Please brief it. Sir, what if see, I have told you one thing. Whenever company wants to distribute money, it can either distribute by giving money out of reserves. It will be termed as dividend. Now that company has already paid taxes on such money. Can you agree with me? Any reserves out of which company is distributing dividend is already taxed. Any reserves is already after tax profit. Reserves are after tax profit. Now, company has already paid tax on such reserves. Now, you want the shareholders to pay tax on that again. It is a basic sense the dividend is taxed twice. So, to avoid that double taxation, what company did? Company, instead of paying money, company gave assets to the shareholders. Company gave assets to the shareholders and claimed that it is not dividend. But section 2, clause 22, subclause A says that if any asset is distributed by the company to the shareholders, it will also be considered as deemed dividend. And how much it will be considered deemed dividend? To the extent of reserves you have. Accumulated reserves you have, it will be considered as deemed dividend. Sir, if you use this and capitalize this reserves into share capital, can you do so? Can you capitalize the share capital? Can you capitalize this profit? Can you capitalize the accumulated profits to reserves? Yes, sir, you can do so by issuing bonus capital. By issuing bonus shares, you can capitalize this accumulated profits into share capital. Can you do so? First of all of you agree with me. Can you capitalize your accumulated profits into share capital? Yes, sir, we can definitely capitalize our accumulated profits into share capital. Then this provision says, if you are distributing any asset to shareholders, it will be deemed dividend to the extent of accumulated profits, whether you have capitalized it or not. Even if you have capitalized your accumulated profits, then too it will be considered as deemed dividend. Even if you have accumulated, even if you have capitalized such accumulated profit, it will be treated as dividend even then. So what I have said, any transfer of capital asset, any transfer of assets by the company, any distribution of assets by the company to the shareholders to the extent of accumulated profits, whether capitalized or not, will be treated as deemed dividend. This is section 2, clause 22, subclause A. Sir, what if company does not distribute any shares? It wants to distribute the debentures. It wants to issue the debentures to the shareholders. What will be it called? It will still be dividend. Any distribution of debentures, deposit certificates, or debenture stocks, or bonus shares to the preference or shareholders. and bonus to preference shareholders. What I have said, and if you are distributing any debentures to shareholders, any bonus, any deposit certificates to deposit certificates to shareholders, or if you are distributing any kind of debenture stock to shareholders, then it will be indirectly creating liability for the company. You are indirectly creating liability for the company. So to the extent you have accumulated profit, such liability will be treated as deemed dividend. That creation of liability will be treated as deemed dividend. It will be deemed dividend to the extent of accumulated profits or not. Or if you are giving bonus to preference shareholders, then too it will be considered as deemed dividend. Sir, what if distribution of assets on liquidation to its shareholder to the extent of accumulated profits? If at the time of liquidation you want to distribute assets, can you do so? Sir, yes, sir, you can do so. Any distribution to the extent of accumulated profits will be considered as deemed dividend. And beyond that, what will be it? It will be capital gain taxable, what we have studied in section 46. Sir, any reduction of share capital and against it giving some assets, it will be also deemed dividend. For example, just listen to example. For example, I have a share capital of rupees 10 lakh rupees, 10 lakh in company. 1 lakh shares of 10 each. Now, against this 1 lakh share of 10 each, company wants to reduce the share capital to 8 rupees each. So it repaid rupees 2 for 1 lakh shareholders. 1 lakh shares, it repaid 2 rupees, and against the repayment, it has not paid money, it has paid some assets whose worth is way more than 2 lakh rupees. It has paid an asset which worth more than 2 lakh rupees. Will it be considered as dividend? Right answer is yes, sir. Any reduction on share capital will also be treated as deemed dividend to the extent of accumulated profits, whether capitalized or not. Even if that profits are capitalized, it will still be treated as deemed dividend. Last but not the least, if a company pays any loans or advance, or if a company sorry, if a payment is made by company to any shareholder who has 10% voting power, or to any person where shareholder has substantial interest, shareholder having greater than 10% voting power has substantial interest, or company pays any money to a person on behalf of such 10% voting power wala shareholder, then such loan or advance will be treated as deemed dividend to the extent of accumulated profits. Sir, what kind of company is covered? Sir, any kind of unlisted company. Company in which public is not substantially interested. Sir, what I'm saying, any unlisted company, simply unlisted company, pays any loans in advance shareholder greater than 10% voting power. Loan in advance to person where the substantial shareholder holds 10%, 20 greater than 20% voting power, or any person on behalf of such shareholder. For example, if a company gives a loan to an employee and that employee in turns remits such loan to any shareholder who has greater than 10% voting power, then in that case, any advance made by that company to that employee or that shareholder in turn will be treated as deemed dividend under section 2, clause 22, subclause E. Now, fundamental issue here is this provision says any kind of loan or advance. Sir, it also consider advances also. It considers advances also. For that matter, things are to be taken with due care. What if I am paying an advance to a shareholder who in turn has to give certain services to me? Is it possible? Is it possible to give advances in ordinary course of business? Right answer is yes, it is possible, because people tend to give advances in ordinary course of business. What will happen in that case? Will that advance be treated as deemed dividend? Right answer is there are exceptions to this provision. If company is giving advance in ordinary course of business, if company is giving advance in ordinary course of business, or advance that is of commercial nature, or advance return to which a service is to be provided to the company, in all these three cases, it will not be treated as deemed dividend. I have an example for all of you. I want everybody to focus. ABC Private Limited. There is a shareholder named Manju Menon. holding greater than 20% shareholding. Manju Menon has a land that it has given to ABC Private Limited, land given. And against that land, Manju Menon is receiving rent. Manju is a shareholder. It has given land, and against it, he's receiving rent. Manju has also authorized company that it can mortgage such land and get loan. Manju Menon has authorized ABC Private Limited to mortgage this land and get loan. Is it possible? Yes, sir, it is possible. Did this company do the same? Yes, sir, it did mortgage this land and yes, sir, it did mortgage the land and took the loan. Now, day by day, performance of the company deteriorated. Manju Menon thinks that he may never be able to get this mortgage, this company may never be able to pay this loan, and for that matter, Manju Menon wants some money against this land because this has already been mortgaged. Manju Menon wants now some money. What can it do? Manju Menon asked ABC Private Limited to get special resolution passed from shareholders. Special resolution passed from shareholders that any loan of any amount can be given to Manju Menon. Manju Menon asked the company to get this resolution passed. It was already passed. It got passed easily because Manju Menon was the greater shareholder. He had an influence. This resolution was passed. Manju Menon also demanded to pay advance rent of rupees 15 lakh rupees. And as soon as months will pass, he will be adjusting this advance rent against the actual monthly payment. What Manju Menon wants is company just pay 15 lakh rupees of advance rent, and every month when rent will accrue, he will adjust this monthly rent from this advance rent. This advance rent was paid on July 2023. Till 31st March 2024, advance rent has been adjusted of rupees 5 lakh rupees, yet 10 lakh advance rent has been given to Manju Menon, and it is outstanding as on the date of 31st March. Advance rent is yet outstanding as on 31st March. 10 lakh advance rent is already advanced to Manju Menon. Company's accumulated balance is rupees 12 lakh. Assessing officer treated this advance as deemed dividend under section 222E. I want all of you to answer whether will it be deemed dividend or not. Will it be considered as deemed dividend or not? Will this dividend be considered as deemed dividend or not? I want all of you to answer. The right answer is, can I say Manju was already required to receive this rent? Manju was required to receive rent every month. And he has just asked for advance against that rent. It has not got any loan from the company. It has just got rent. And against this rent, Manju was required to pay. Manju was required to give services of providing land. Can this advance be treated as ordinary course of business? Right answer is yes, this advance is of ordinary course of business. And against this advance, shareholder is required to give certain services. What services? Shareholder is required to give his land in return. And for that matter, this will not be deemed dividend. And believe me or not, this was a question asked for 4 marks in May 24 examination. This was the question asked in May 24 examination. Let's go back to the topic, what it says. (222) is not applicable in case of ordinary course of business, commercial nature, or return to which services has to be provided to the company. Where asset is distributed under section 222A, when asset is distributed, sir, in case of liquidation or in case of reduction in share capital, then FMV of such asset shall be on the date of the distribution shall be taken for computing dividend. Sir, whether capitalized or not means increase in bonus capitalization. What it means, sir? For example, if company has share capital of 1 CR, accumulated profits of 5 CR, company distributes bonus of 5 CR and increases the share capital. Sir, can I say that now share capital is 6 CR and accumulated balance is 0? Can I say that share capital has been accumulated, this accumulated balance has been capitalized to share capital? This is what we call capitalized or not. In share case issue by share capital is issued by bonus, or it can transfer this accumulated profits to reserves. These are two ways of capitalizing. So one more thing to be taken care of is last thing. Whenever we are studying any deemed dividend under section 222A, 222B, 222C, 222D, all these provisions says distribution to the extent of accumulated profits, whether capitalized or not. Whether capitalized or not. But whenever we are studying section 222E, it says only to the balance, to the extent of accumulated profits. It does not seek any type of capitalization. So in case 222E, if you capitalize your profits, then you are not required to pay dividend. This is the bottom line of this topic. I hope that things are really very clear. Just give me a second. Just give me a second. Okay, so taxation of interest income. Whenever we are studying taxation of interest income under income from other sources, we have to understand what type of income we are receiving. If income is exempt, then it will not be taxable, and if it is taxable, then you have to consider when you have to tax it. Whenever income is received, interest income is received on account of loan advanced or any kind of securities, for example bonds, then interest shall be taxable under that IFRS if it is not your business. For example, your business is of providing loans, then it will be taxable under PGBP. But if your business is not providing loan, then it will be IFRS, and it will be taxable in the year of accrual and not in the year of receipt. Second case, when you receive interest on FD, bank deposits or recurring deposits or savings account, any kind of such interest will be taxable under that income from other sources. It will be taxable under the year in which it is accrual. It will be taxable in the year of accrual. Last, the most important thing, whenever your excess tax is paid, you are entitled refund for that. That refund is also entitled with interest. You are also eligible for interest on such IT refund, and that interest on IT refund will be taxable in the year of receipts. So these three are taxable interest, will be taxed in the head other sources. There are certain exempt income you need to know. First of all, any interest accruing on account of public provident fund will be always exempt. And second thing, any interest accruing from post office savings account will be exempt to the extent of rupees 3,500 if it is being received by individual, or rupees 7,000 if it is being received on joint account. Interest will be exempt. And third important thing is interest on gold deposit bonds will be also exempt. Do you remember where did we study this gold deposit bonds? Do you remember? Day before yesterday, when we were studying capital assets. Just have a look. When we were studying capital asset, I told you all kind of assets are capital asset, but 4 kinds of assets are not capital assets. First of all was stock in trade. It is not a capital asset. Any kind of movable personal asset was not a capital asset. Any kind of rural agriculture land in India is not a capital asset. And any gold deposit bond and deposit certificate is not a capital asset. Interest on such gold deposit bond is also exempt. The same thing that you are studying under IFOS head, that interest under gold deposit bond is exempt. Therefore, for that matter, whenever you see interest on gold deposit bond, it will be completely exempt. Got this point or not? There is a catch. There is a catch that you all must be aware of. There is a catch. What I am saying is, whenever you do an FD, and that FD is necessary for the conduct of the business. Whenever you do FD or security deposit or any kind of advance which is leviable for interest, is necessary for the conduct of the business, then such interest will be taxable under the head other sources. For example, you are doing a business which require a lot of electricity, and for that matter, you are required to deposit too much of security deposit at NPV office or that electricity office. You are also entitled to such interest. You are entitled to interest on such security deposit. Any such interest on security deposit will be taxable under that PGPP, because that FD, that security deposit, is necessary for the conduct of the business. In that case, it will be taxable under that PGPP. It will not be taxed under the source, under other sources. Just write it over here. Otherwise, we'll forget this. I want all of you to write this line. If FD, security deposit, is necessary for the conduct of the business, like electricity deposit, then interest on such FD or security deposit will be taxable under the head PGPP and not under the head IFRS. Did you get this point or not? This was all about interest income in taxation of interest income. Now, next important thing, interest income from renting of plant and machinery. Whenever we are receiving any income from renting of house property, it is taxable under house property. Whenever we are receiving any income from renting of plant and machinery in ordinary course of business, then it will be taxable under PGP, taxable under the head PGPP. Or if it is not your business, if it is not house property, it will be taxable under the head other sources. Got this point or not? Got this point or not? Yes, sir, it is very much clear. So whatever the rent amount we are receiving will be written as gross rent, and any deduction under section 57, like repairs, like insurance, like etc., any deduction that has helped you to earn such income will be reduced from such income under section 57 deduction. Got this point or not? Yes, sir, we did understand. The most beautiful point is taxation of gift. Taxation of gift is the most important topic of this chapter, and you need to be very much aware while studying this topic. I'm here to simplify for you. So I want your focus for at least half an hour from now. What I'm saying. See, whenever you receive gift, for purpose of understanding gift taxation, any kind of property, any kind of asset received for free of cost will be gift, or any kind of asset or property received for inadequate consideration will also be treated as gift. For example, property has FMV of rupees 1 crore, but you are receiving it for 90 lakh rupees, then 10 lakh will be gift. That means inadequate consideration will be also treated as gift in this case. So gift implies anything received for free or anything received for inadequate consideration. Sir, we have two types of gift. First, a category of gift that is always exempt and a category of gift that is always taxable. First, let us understand what is exempt gift. First of all, any kind of gift received from relative will be exempt. Any kind of gift received from relative will be exempt. Sir, who are relatives? We will study later on. Any kind of gift received on account of marriage, for example, I am getting married, whatever gift you will be giving to me on my marriage, it will be completely exempt. It will be completely exempt in my hands. Third thing, any kind of gift received on account of will, on account of inheritance, it will be completely exempt. For example, if a father dies, or any property received by his son on account of will, on account of inheritance, it will be completely exempt. Any kind of gift received due to the death of the donor or payee. For example, if a property is received by the bank on account of reverse mortgage scheme, any property received by the bank on account of death of the property, the death of the donor, it will be exempt. Sir, any of the gift received from local authority, it will be exempt. Or any of the gift received from or by any trust, any hospital, any institution that is registered under section 12 AB or 1023C of Income Tax Act will be exempt. These things are less important. Sir, any gift received by individual for treatment of COVID for himself. If I am receiving any money from anybody, any money from anybody for my treatment for COVID-19 or for treatment of my family from COVID-19, it will be completely exempt. Or if anybody dies on account of COVID-19, any ex gratia received by his family or his relatives. What I'm saying, if a person died in COVID-19 His family received any kind of ex gratia either from employer or any of other person, that will be that will be exempt. But two or three conditions you need to take care of. What conditions, sir? Any money received by the family members of the deceased person in the COVID-19 will be exempt, but it will be exempt if received from employer. Every money received will be exempt. 100% of the money received from the employer will be exempt. But if ex gratia is being received by, if ex gratia has been given by somebody else, for example, government gave you ex gratia, your relatives gave you ex gratia, in that case, it will be exempt to the extent of 10 lakh rupees only. Got this point or not? Two most important conditions, sir. Death must have occurred within 6 months from getting COVID-19 positive. If a person is if a person is tested COVID on a date, death must have occurred within 6 months, and ex gratia must have been received within 12 months from the date of the death. These two conditions must be always complied while receiving any ex gratia on account of death of COVID deceased person. What I have said, just focus here what I am saying. Any kind of money received by the family members of a person who is deceased in COVID-19 will be exempt. But received from employer always exempt, received from any other person exempt to the extent of 10 lakh rupees only. Sir, death must have occurred within 6 months from the date of being COVID-19 positive, and ex gratia must have been received within 12 months from the date of death. That has to be taken care of. Last exempt gift will be if an individual creates a trust for benefit of its own relative, for benefits of an own relative. If an individual creates any trust for benefit of its own relative, then any asset received by such trust will be exempt. Any trust, any asset, any money, any gift received by such trust will be exempt. This point is of least importance, but there is one question in your study material. There is one question in your study material that is relevant for your exam. For that matter, this point has to be studied seriously. Did you get this point or not? Yes, sir, we did get. So just repeat after me. What gifts are exempt? Sir, any gift received from relative, exempt. Any money received on marriage, exempt. Any money received on account of will be exempt. Any money received on account of death will be exempt. Any money received from local authority will be exempt. Any gift received by or from trust, hospital, institution registered under section 12 AB or 1023 of Income Tax Act will be exempt. Any money received by the trust from an individual created for the benefit of the relative of such individual will also be exempt. Any money received for the COVID-19 treatment for yourself or for your family will be exempt, or any money received by the family members of the deceased person died in the COVID-19 will be exempt. But if received from employer will be 100% exempt, but received from any other person will be exempt up to 10 lakh rupees. Two conditions: death must have occurred within 6 months from the date of being COVID-19 positive, and ex gratia must have been received within 12 months from the date of death. Did you get this point or not? Yes, sir, we did understand what you are trying to say. Now there is only one question, sir, only one question. Just tell, sir, what is meant by relative? What is meant by relative? You told these all gifts will be exemptive. Gift from any relative will be exemptive. Exempt. What will be the meaning of relative here? I want your focus for at least 2 minutes. I want your focus to be focused for at least 2 minutes. Just have a look at this. What I am drawing. I am an individual. Everybody can see I am an individual. My wife will be my relative. Wife, or I can say spouse. My spouse will be relative. My lineal descendant, that is my son, my daughter will be my relative. Their spouses will be my relative. My son's spouse, my daughter's spouse will be my relative. Sir, my brother will be my relative. Brother's spouse will be my relative. My sister will be my relative, and my sister's spouse will be relative. Sir, not only this. Sir, my spouse's brother and his spouse will also be my relative, and my spouse's sister and her husband will also be my relative. We have not stopped yet, buddy. Individuals, mother and father will also be my relative, and mother's brother sister and their spouse, we call them mama, mami, mausi, masaji, and father's brother sister and their spouse will also be relative. For example, if you understand Hindi, your mama, mami, mausi, mausaji, Bua, Fufaji, and Chacha, Chachi all will be relative. Getting me? Mother's brother, father. Sorry, mother's brother, sister, and their spouses. Father's brother, sister, and their spouses. And in context of spouse side, only mother father of spouse will be relative. There is no concept of brother sister of mother of spouse. There is no concept such. And any kind of lineal ascendant and their spouse, lineal ascendant and their spouse. Can you see a kind of creature in this picture? Can you see a kind of creature in this picture? Sir, we can see a mouse, a mouse. You have to remember this mouse whenever we are studying the definition of a relative. Whenever I refer section 56 210's relative, you have to picturize this mouse. Whenever you will be able to picturize this mouse, it is for sure that you will never make mistake in understanding this provision or recalling the relatives that are referred herein. Getting me or not? Arey bolo na, getting me or not? Yes, sir, we did understand what you are saying. We did understand very well what you are saying. So this is the kind of relation that section 56 to 10 says. Think it of a mouse. See, I had asked team to draw a regular mouse, but they were very much creative, so they drew different kind of mouse. See, an individual, his spouse will be relative. Any kind of lineal descendant and their spouse will be relative. Any brother of individual and their spouse, sister of individual and their spouse, spouse's brother and their spouse, spouse's sister and their spouse, mother, father of individual, mother's brother and their spouse, father's brother and their spouse, mother, sister and their spouse, father, sister and their spouse, spouse's parents, your lineal ascendant and their spouse, and spouse's lineal ascendant and their spouse. Yeah, I don't understand this English language, because if whatever relation your mother's brother have with you, you call him uncle. Your father's brother will also be uncle. Your mother's brother will be your uncle, your father's brother will also be uncle. So any kind of relation is called uncle here. But I'm not comfortable speaking such word. English, uncle, I don't think you will be able to understand properly. Whatever relation I have said, you just need to remember that only. For an HUF, who will be a relative? Any member of a HUF will be relative. For example, my father has an HUF. We are having 4 members in HUF. Every member is related to each other. We will be relative. Any gift transferred to each other will be exempt. Now I have to focus on the different aspect of this gift. All these gifts that I have told you till now are exempt category gift. These gifts are exempt from tax. Any gift received on such account, on these accounts will be exempt. But any gift received elsewhere will be taxable. Any gift received else will be taxable. For example, I love Shraddha Kapoor. If you remember Shraddha Kapoor, Bollywood actress, I love Shraddha Kapoor. Too full of my heart. I love her. I had thought to give Shraddha Kapoor money, all the money that I have. I have collected penny, and gave her 1 lakh rupees as gift. Shraddha is not related to me in any sense. Shraddha is not related to me in any sense. But I gave this 1 lakh rupees to Shraddha. Can I say there is transfer on my account? Transfer on my account. Sir, money is not a capital asset. Money is not a capital asset. Money is not a capital asset. Yes, sir, money is not a capital asset. Sir, because every asset is a capital asset, but movable personal asset are not capital asset. Money is movable. It is not a capital asset. Money is not a capital asset now. But whenever Shraddha receives such money, it will be treated as gift in her hands. If money received by Shraddha in aggregate for a financial year is greater than 50,000, it will be taxable. She refused to take my money. She refused to take my money. She said already money in her hand is taxable at 30% tax rate. She has refused to take any money from me. She did not take my money. I am crying. I thought, why not to give my mother's jewelry to her? Why not to give my mother's jewelry to her? Jewelry had FMV of 20 lakh rupees. I gifted to her. Sir, provision says any kind of movable property whose FMV is greater than 20 lakh rupees will be taxable in the hands of Shraddha. So 20 lakhs again will be taxable. Sir, what if I said I'm not giving it for free? I am not giving it for free. I said to Shraddha, I am not giving you this for free. I am charging you 1 lakh rupees for that. Sir, can I say it is a case of inadequate consideration? Can I say it is a case of inadequate consideration? Yes, sir, it is a case of inadequate consideration. In that case, how much amount will be taxable? So simply FMV will be 20 lakh. She is paying me 1 lakh. So 19 lakh has to be gift amount. Yes, sir. How logical you are. How much brain you have. It is correct that whatever money that she is giving will be reduced from FMV of the asset will be taxable in her hand. Just have a look at this chart. Just have a look at this chart. What this chart says. Sir, any gift received other than exempt gifts. Sir, we are not talking about exempt gifts. Any gift received other than exempt gift. If money is being received and money received is greater than 50,000, then entire money is taxable. If any movable property is received, any kind of movable property is received, sir, if it is received for without consideration, sir, for example, jewelry is received by Shraddha and she received that jewelry without any consideration. For example, I gave her jewelry of 20 lakh rupees. Sir, if FMV is greater than 50,000, entire FMV will be taxable in her hands. Sir, but I charged certain consideration for her. Sir, I charged her 1 lakh rupees. I charged her 1 lakh rupees. It was inadequate consideration. She also knew, I also knew that it is inadequate consideration. For that matter, I charge inadequate consideration. In that case, provision says if FMV minus consideration is greater than 50,000. In our case, it is greater than 50,000. If FMV minus consideration is greater than 50,000, then entire FMV minus consideration will be taxable. So in her hands, 19 lakh rupees will be completely taxable. Did you get this point or not? Did you get this point or not? So what if I gave Shraddha a property? What if I gave Shraddha property? Provision says if you give any property without consideration and SDV of such immovable property, SDV of such land or building is greater than 50,000, then entire SDV will be taxable in her hands. Entire SDV will be taxable in her hands. What this point? Sir. Any kind of immovable property given to her at inadequate consideration. For example, sir, property was of rupees 20 lakh rupees. I charged her rupees 1 lakh. I charged her 1 lakh rupees. Sir, what will be taxability? So difference has to be taxable. Difference has to be taxable. But provision says something different. Provision says if SDV minus consideration, is greater than 50,000. Is it in our case? Sir, SDV is 20 lakh rupees. Sir, consideration is 1 lakh rupees. Sir, difference is 19 lakh rupees. Is it greater than 50,000? Yes, sir, it is greater than 50,000. Also, sir, remember section 50C. Is SDV greater than 110% of consideration? Is SDV greater than 110% of consideration? Right answer is yes, sir. 20 lakh is greater than 110% of 1 lakh. So if both the conditions are satisfied, then entire difference will be taxable in Shraddha's hand. Sir, what amount of difference is 20 lakh is by SDV, 1 lakh she is paying. So difference will be 19 lakh and it will be taxable in the hands of Shraddha. Got this point or not? Got this point or not? A few things to be taken care of in these cases. A few things to be taken care. What are few things? Sir, while considering 50,000 rupees, for example, somebody receives money rupees 15,000, jewelry rupees 25,000, and shares worth rupees 20,000. These are the freebies that they have received, or gifts, I should say, they have received. Sir, what is the total? Total is 60,000 rupees. If you can do total is 60,000. Will it be exempt or not? Since money is lesser than 50,000, it should be exempt. Sir, movable property is lesser than 50,000, received is lesser than 50,000. Will it be exempt? Right answer is whenever you are considering this limit of 50,000, you have to aggregate the money received and movable property. You have to aggregate this money received and movable property. Got this point or not? Did you get this point or not? Sir, you have to aggregate the money and movable property for considering the limit of this 50,000. Okay, yes, sir. Now the most important thing, sir. What is movable property? Sir, what is movable property? Sir, for the purpose of section 56(2)(10), movable property implies any kind of securities, shares, jewelries, bullion, artificial, any other form of art, paintings, sculptures, or any kind of virtual digital asset. Sir, what it says, any type of shares, securities, jewelries, drawing, painting, sculptures, archaeological collection, or any other form of art, bullion, and virtual digital asset. Any kind of property, sir, any kind of property will not be taxable under the head gift. Only these 10 movable properties, if received as gift, will be taxable in the hands of the recipient. What if, sir, I gave cars to Shraddha? Will it be taxable? Right answer is it will not be taxable in her hands. It will not be treated as gift. What if I gave her a watch? Will it be taxable? No, sir, it will not be taxable. What if I gave her 10 iPhone 16 Pro Max? Will it be taxable? Right answer is no, it will not be taxable. Only these 10 properties will be taxable. Sir, shares, securities, drawings, paintings, sculptures, archaeological collections, any other form of art, bullion, virtual digital asset, and one thing I forgot. These 10 things will only be taxable in the hands of the recipient if they are part of movable property. Only these things will be considered as movable property. Rest all the things are removed from the definition of the movable property. Therefore, if you want to gift anything of any value, you can gift to your beloved ones. But just consider these 10 things. If you are gifting these 10 things, you have to consider whether you exceed limit of 50,000 or not. If you exceed limit of 50,000, it will be taxable in their hands under the head gift under the other sources table. Got this point or not? Last but not the least, sir, you are throwing bouncers to bouncers on us. Last thing you need to remember, any kind of gift given shall be capital asset. It should not be stock in trade. Any kind of property shall imply capital asset. It should not imply any kind of stock in trade. Sir, for example, for Shraddha, sir, her business was trading in property. Any kind of property received at a lower consideration or any kind of property received for free of cost, will it be taxable in her hands? Right answer is if it is stock in hand for her, it will not be taxable. If Shraddha deals in shares, she is a share market enthusiast. She is trader in stock market. If she receives any kind of shares at free of cost or any kind of shares at a lower consideration, inadequate consideration, will it be taxable in her hands under the head IFOS? Right answer is no, it will not be taxable because any kind of gift received will be taxable only if it is received as capital asset. In stock in trade, it will not be taxable. These are the few things that you need to remember. Sir, what I said, sir, gift any money received greater than 50,000 taxable. Any movable property implies any kind of shares, securities, jewelries, drawing, painting, sculptures, archaeological collection, any other form of art, bullion or virtual digital asset. This implies movable property. Any movable property of FMB greater than 50,000 received to me, will it be taxable? Yes, sir, it will be taxable. Any movable property greater than 50,000 FMB or, sir, received at inadequate consideration, then FMB minus consideration, if greater than 50,000, will be taxable in my hands. If any immovable property received and SDV greater than 50,000 and it is received for free, it will be taxable. SDV will be taxable. But if any immovable property is received at an inadequate consideration, then we have to check whether SDV minus consideration is greater than 50,000 or SDV is greater than 110% of consideration. Then SDV minus consideration will be taxable. I hope I spoke a bit faster, but it made sense. Got this point or not? Sir, 56.210, that is gift provisions are not applicable in following cases. See, we are revising things. This power batch aims at revision. You all know these things. You already know these things. We are just revising these things. 56.210 is not applicable in the following cases. Sir, what are the cases where 56.210 is not applicable? First of all, it says, sir, whenever shares of Yes Bank has been acquired at the time of reconstruction of schemes. For example, sir, Yes Bank shares were trading at 14 rupees, but it was about to be bankrupt. Yes Bank was about to be bankrupt. It was at a position of liquidation. But to rescue that bank was supposedly to be given to any other bank to function. Management of Yes Bank was required to be takeover. That company was necessarily to be sold to protect it from liquidation. So for that matter, government interfered and asked SBI to buy shares of Yes Bank at rupees 11. For example, SBI bought 1,000 crore shares of Yes Bank at a lower price. Can I say SBI was benefited by 3,000 CR? Can I say this? These shares received at inadequate consideration will be treated as gift in the hands of SBI. Right answer is no. Any shares of Yes Bank received by the investor under reconstruction scheme, it will not be treated as gift. So under reconstruction scheme, since it is received, it is not treated as gift. So if you receive any shares of a company or shares of subsidiary of a company or shares of the subsidiary of a company, by shareholders whose board of director has been suspended by the NCLT. Simply NCLT. If company's board of directors has been suspended and you receive shares of that company at a lower consideration, or you receive the shares of the subsidiary of the company or subsidiary of such company, then any inadequate consideration paid will not be liable for gift under section 56(2)(10). Sir, any equity shares of a public sector undertaking received by the person under strategic disinvestment scheme. So strategic disinvestment scheme implies any scheme governed by the government through which it reduces its shares capital, it reduces its percentage shareholding in that PSU to a certain threshold. In that scheme, many a times shares are being sold at a very lower value, and if any person acquires such share at a lower value, that income will not be treated as gift in his hands. And last but not the least, any kind of gift received like car, sir, mobile watch, wristwatch will be completely exempt, sir, because it is not a movable property. It is not a movable property. It is not a movable property. Got this point or not? I want you all to focus at this page number 58. So now I want all of your focus for a few minutes, because we are talking about gift of immovable property. Whenever an immovable property is given as gift, we have to talk about that. Whenever an immovable property is given as gift, we have to talk about that. Sir, whenever an immovable property is given for no consideration or inadequate consideration, I want all of you to focus. If immovable property is held for the transfer, for example, transferor is Rahul and transferee is Shraddha Kapoor. Okay, Shraddha Kapoor. Transferor, for example, Rahul held such property as capital asset. Sir, held such property as capital asset. He gave that property to Shraddha. He gave that property to Shraddha at free of cost. Sir, what will be tax implication? What will be tax implication? Sir, if I am giving Shraddha this property as gift for no consideration, if I am giving this property to Shraddha as gift under section 47, then it will be completely exempt. It will be completely exempt. But if I am giving this property to Shraddha at a lower consideration, then one provision will wake up. Section 50C, which states that if any asset is transferred and SDV is greater than 110% of consideration, then SDV will be treated as consideration. So capital gain will arise in my hands under section 50C. What I'm saying, if transferor holds such asset as capital asset, he transfers such property at a free of cost. If he transfers such property at without consideration, it will be exempt in his hands. Gift provisions will apply under section 47. But if he transfers such property at a inadequate consideration, in that case 50C provisions will apply and he will be chargeable to capital gain tax. What if such property is held as stock in trade by Mr. Rahul? Sir, if property is held as stock in trade by Mr. Rahul, any transfer at lower consideration, whether be it free gift or be it at a lower consideration, sir, one provision will arise. It is section 43CA. Section 43C is indifferent. It is completely similar to section 50C, which states that if SDV is greater than 110% of consideration, if SDV is greater than 110% of consideration, then SDV shall be full value of consideration. Sir, it does not even exempt a gift as transfer. Whenever you hold such capital asset, whenever you hold a capital asset whenever you hold a property as a stock in trade, whenever you hold a property as stock in trade and you transfer such property at a lower consideration, gift provisions will not apply, exempt transfer provision will not apply. Simply 43CA will apply. If SDV is greater than 110% of consideration, then SDV will turn consideration. That means if property is held as stock in trade for Rahul, and he transfers such property even without consideration or at inadequate consideration, then provisions under section 43CA will apply to Mr. Rahul. Got this point or not? Yes, sir, we did understand what you are saying. Sir, what for transferring? For transferring, if such asset is held as capital asset. For example, Shraddha, a recipient of gift, holds such asset as capital asset. Sir, what will happen? She'll be chargeable to gift under section 50 to 56 to 10. Sir, if SGV is greater than 110% of consideration or SGV is greater than 110% of consideration, in that case, difference will be taxable under section 56 to 10. But if Shraddha holds such property, if Shraddha holds such property as stock in trade, what will happen? For stock in trade, provision under section 56 to 10 will not apply. No tax will arise in her hands. Got this point or not? Got this point or not? Yes, sir, we did understand. We did understand. So one thing to be taken care of, sir, whenever somebody is not satisfied with the SDV calculated, in that case, again, he can refer to valuation officer. The same we studied under section 50C. Whenever you are not satisfied with SDV, you can go to valuation officer. Valuation officer will determine SDV. If valuation officer determines SDV greater than previously determined, you can ignore his valuation. If valuation officer determines SDV lesser than previously determined, you can go with the valuation officer's SDV. That is the basic thumb rule. You can proceed with the same case. Sir, Shraddha received this property. Shraddha received this property. Simple thumb rule I'm telling. Shraddha received this property. Can Shraddha sell this property later on? Can Shraddha sell this property later on? Yes, sir. Shraddha can sell this property anytime. If she has received this property, it is bound that in future she will be selling this property. Sir, what will be cost of acquisition whenever she sells such property? What will be the cost of acquisition in her hand if she sells such property? You have to take care of three cases. You have to take care of three cases. Sir, if Shraddha and Rahul are relatives, then whatever transfer has been done will be exempt transfer. It will be exempt in the hands of the Shraddha under 56 to 10. And cost of acquisition of Rahul will take place. Sir, what case I am telling, if Shraddha has received such property, on account of exempt transfer under section 57 and on account of relative, Rahul being relative, it will be exempt in her hands. So cost of acquisition will be cost of previous owner. But what if transfer was taxable in the hands of the Shraddha? Transfer was taxable in the hands of the Shraddha. Shraddha held such capital asset. Shraddha held that property as capital asset. It was taxable for her hands. So what will be cost of acquisition? Tax paid will be cost of acquisition. The SDV on which Shraddha was liable to tax, will be her cost of acquisition. And at last, any if she holds such property as stock in trade, any amount paid as consideration will be cost of acquisition. I have written it here. I will be making you correct here. I have written here. It will be, you will get corrected this. SSC, not assessed to tax under section 56 to 10. In case transfer was exempt. In case transfer SSC was not assessed to tax, then it will be transfer cost of acquisition of the transferor. But in case transfer was taxed, for example, Rahul gave to Shraddha and it was taxed in the hand of the Shraddha under 56 to 10. What will be the case? Case will be FVOC or SDV on which tax has been paid by the Shraddha will be cost of acquisition. Because simply we are talking about capital asset. For stock in trade, there is no provision of gift, there is no provision of capital gain. So we are not talking about stock in trade. But if we are talking about capital gain, capital assets, so in that matter, things become relevant. Whenever asset is being received by Shraddha, if it is received on account of exempt transfer, cost of acquisition will be cost of acquisition of the previous transfer. But if Shraddha pays tax under section 56 to 10, then cost of acquisition will be SDV or FPOC on which Shraddha pays the taxes. Got this point? Got this point? Simply it is written here, but it feels a bit complicated. I have corrected this, need not to worry about this. Sir, family pension. What about family pension? How family pension is taxed? Normally, a family pension is received after the death of the employee. So if any employee dies, many a times government employees receive family pension after their death, the death of the employee. How it is deduction? How you get deduction? Right answer is deduction allowed is 1/3 of the family pension received. For example, annual family pension received is 1,50,000 rupees. So, sir, 1/3 will be exempt, or sir 15,000 per annum, whichever is lower is exempt. So either it has to be 50,000 or 15,000, whichever is lower will be exempt. It will be exempt, or it will be allowed as deduction under section 57, whatever the case may be. But this is the family pension. So next, if family pension is received by recipient of Paramveer Chakra or Veer Chakra, sir, these are chakra given to army person. If a person who dies and who has been honored with Paramveer Chakra or Veer Chakra, any family pension received by their family will be exempt. Or any family pension received by the widow or children of the officer who were at the time of who were in the armed forces or paramilitary forces will also be exempt. For example, if any person who is in the armed forces or paramilitary forces dies, and any family pension received on account of his death to his wife or to their children, then in that case family pension received will be completely exempt. This was all about family pension. Now, a concept that is really very important for your exam but has been abolished from next finance act, so you have to take care of this point, because ICI is very intelligent in asking these type of topics. Sir, angel tax, simple concept, sir. A simple concept. If shares are issued at premium, first of all, provision says if shares are issued at premium, this provision will apply only if shares are issued at premium. Sir, if shares are issued at premium and even issued above their fair market value, see, there is fair market value of every share. Fair market value of every share. If shares are issued over and above the premium, and even they are being issued over and above their fair market value, in that case, whatever the money that company receives over and above the fair market value will be chargeable to angel tax under section 56(2)(7)(b). Read along with me. You can remove this word resident because resident word has been removed. Any shares issued to resident shareholders by closely held companies. See, the provision applies only to closely held companies, that is unlisted companies. Listed companies can issue shares to anybody. These provisions are applicable to unlisted, because listed shares are being valued by the general shareholders, so they can never be issued greater than fair value. But unlisted companies or closely held companies, I should say, are being benefited by these laws. If any shares are issued to shareholders by the closely held companies, then issue price minus fair market value of such shares shall be taxable under the head IFOS. Got this point, sir? But there are certain exceptions. Sir, what exceptions? What all exceptions we need to study? Sir, 56(2)(10) is 56(2)(7)(b) is not applicable to the 56(2)(7) is not applicable to funds received from venture capitalist company, venture capital fund, or AIF category 1 and 2. Sir, if any of the unlisted company receives any kind of fund from venture capital company, venture capital fund, or any kind of alternate investment fund category 1 and 2, we'll study about category 1 and category 2 in detail in investment fund topic. But any kind of money received on account of, sir, venture capital company, or alternate investment fund 3 will not be chargeable to section 56(2)(7) or angel tax. I will be referring angel tax from now onwards. Any kind of money received on account of angel tax any kind of money received from venture capitalist fund, venture capital company, and alternate investment fund category 1 and 2 will not be chargeable to angel tax. Second thing, sir, if such consideration is received by the eligible startups not chargeable to angel tax, and money received from venture capitalist fund company and AIF 1 and 2 will not be chargeable to angel tax. Sir, what are eligible startups? We have to study in detail what are the eligible startups. See, I have tried to simplify these things to the fullest. I have literally tried to simplify these things to the fullest. You just once go to study material of ICI and find out what they have written and how simply I have simplified these things in this book. You will appreciate this when you study yourself. So what it says, sir, eligible startup implies any business working towards innovation, development, and employment generation. Complete knowledge, complete unnecessary knowledge, unwanted knowledge. Second thing, whose turnover is up to 100 crore per annum for 10 years since incorporation. From the date of incorporation, for every year up to 10 years, the turnover should not cross 100 CR per annum. Turnover in any of the financial year from the date of the incorporation till now. Within 10 years from the incorporation, turnover shall not be greater than 100 CR per annum. Sir, third thing. First was simple, ignorable. Second thing, turnover is per annum. You cannot do anything about this. Third thing, sir, paid up share capital plus security premium after issue shall be up to 25 CR only. It says any startup who wants to be an eligible startup now cannot have paid up share capital or security premium exceeding 25 CR. He cannot have paid up share capital or security premium exceeding 25 CR. So, but this will possess a difficulty. This will possess a difficulty. So, because many a times they issue very much, they issue 100 CR of capital. How will they do? How will they survive if share capital plus security premium is up to 25 crore? So, sir, government gave exception. Government gave some provisos stating that while calculating the limit of 25 CR, we will exclude investment from these following investors. What I'm saying, eligible startup, turnover 100 CR, paid up share capital plus security premium only 25 crore. While calculating limit of 25 CR, we have to exclude investment from these people. Sir, whom we have to exclude? Any investment by venture capital company or venture capital fund. Any investment by venture capital company and venture capital fund will not be included in 25 CR limit. Any investment by non-resident or any investment by the companies, which is a big company. I'm just saying big company to refer you. Otherwise, we'll be studying in detail. Sir, what I'm saying, while calculating limit of 25 CR, exclude venture capital funding by venture capitalist company or funds, exclude funding by non-resident or exclude funding by big companies. Sir, what are big companies? Any companies whose share are frequently traded, for example, like Reliance. Any company whose net worth is greater than 100 crore on the 31st March of the preceding financial year of the date of the issue. On the date of the issue. Sir, whatever balance sheet is available, as per that balance sheet, it should not have net worth greater than 100. It should have net worth greater than 100 CR. And last but not the least, turnover of such company shall be greater than 250 CR in preceding year to the date of the issue. All these three conditions are to be complied in finding out the one which is a big company. What is an eligible startup? A startup involved in innovation, development, and employment generation. Second thing, what eligible startup does, it has turnover up to 100 CR for 10 years, not more than that. Third thing, its paid up share capital and security premium does not exceeds in any sense greater than 25 CR. But for computing limit of 25 CR, following investments are to be excluded. What investments are to be excluded? First of all, any investment by venture capital company or venture capital fund. Any investment by non-resident or any investment by the big company. Sir, what are big company? Sir, big company is a company whose shares are frequently traded and whose net worth is greater than 100 crore as per last financial statement and whose turnover is greater than 250 CR as per last financial year preceding the year of issue. Did you get this point? What is a big company? What is an eligible startup? Plus, sir, fourth condition. This was the first condition. This was the second condition. This is the third condition. Fourth condition states that eligible startup shall not invest in the following assets within 7 years from the end of the financial year in which shares are issued at premium. For example, sir, I told you these three things make a startup as eligible startup. Once funding is being raised, sir, from the end of that year up to 7 years, such eligible startup shall not invest in following assets. Otherwise, they will cease to become an eligible startup. Sir, in what asset classes they should not invest? Sir, please tell me. There are 7 asset classes. What it says? They should not invest in residential house property or immovable property. Sir, they should not give loan or advance to anybody. Sir, they should not make capital contribution to any other entity. For example, they should not invest in partnership firms or any kind of LLPs. They should not buy any shares of securities. So they should not buy shares of securities. Sir, they should not buy any jewelry, artistic work, bullions. They should not buy motor vehicle, yacht or aircraft beyond 10 lakh rupees. So they should not do these things. But these all things are allowed if it is done in ordinary course of business. For example, if eligible startup has a business of renting of immovable property, then they can buy property. If eligible startup has a business of giving loans in advance, they can give loans. Otherwise, they cannot. If eligible startup has a business of contributing to other entity, if it has business of share trading, it has business of jewelry, or it has business of motor vehicle, then they can do business. They can buy these assets. Otherwise, they cannot buy these assets. Getting me? Which implies, sir, eligible startup shall not invest in the following assets unless it is in the ordinary course of their business. They cannot invest in such assets till when? Till the end of the 7 years from the end of the financial year in which shares are issued at premium. Last but not the least, sir, why Byju's or these big startups are not taxed under angel tax? Why these big startups? There is funding of millions. Don't you think that their capital would have increased to greater than 25 crore? Don't you think Byju's must not be having any residential property? The Byju's must not be having any shares, sir. They are investing in many of these shares. They are acquiring many companies. Sir, Zomato not acquiring any shares. Believe me or not, these are not eligible startups. First of all, 10 years have lapsed from their incorporation. Second thing, their turnover is greater than 100 CR. They are not eligible startups. So if you are facing any doubt now, you need to check whether it is an eligible startup. Most of the companies that you are seeing right now are big. They are not eligible startup. Unacademy is not eligible startup. Boat is not eligible startup. Their turnover is in 1,000 crores. We are talking about companies which are at inception. These are having only 100 crore turnover, that too up to 10 years from the date of the incorporation. So these things are to be taken care of. So this was about angel tax. So now section 57, allowable expenditures, allowable deduction. These deductions will be allowed as deduction. So whenever you are earning any kind of dividend income from either mutual fund or any share, sir, you are allowed expenditure. You are allowed certain expenditure on such dividend income to be allowed as deduction. You are allowed some deductions. Sir, which deduction is allowed? For dividend income, you can only reduce interest expenditure up to 20% of the dividend income. So what I am saying, I received a dividend from mutual fund, 10 lakh. Dividend from shares, 20 lakh. Dividend from business trust, sir, 10 lakh. Dividend from deemed dividend, I received 20 lakh. How much dividend I received? I received a dividend of 60 lakh rupees. How much interest can I pay? Sir, it says 20% of such dividend income you can use as, you can take as deduction. What 20% implies? So 20% implies that is 12 lakh deduction you can take under section 57. So only deduction allowed for dividend income is interest income. That too only 20% of the dividend income is allowed as deduction. Sir, for if I receive any interest on compensation of compulsory acquisition under any law, sir, we have studied 50% deduction is clearly allowed. 50% deduction is clearly allowed. Third thing, if any expenditure is wholly incurred to earn such income, for example, sir, I pay interest to earn interest. For example, sir, I have received interest, I have received money at a lower interest, for example, 10%. And I am lending such money at 12%. For earning this 12%, I am paying this 12% now. So this 12%, 10% will be allowed as deduction under section 57. Sir, for example, for renting of plant and machinery, I am paying brokerage to somebody. Will it be allowed as deduction? Right answer is yes, it is be allowed. Yes, it will be allowed as deduction. Sir, simply provision says any expenditure incurred wholly or exclusively to earn such income will be allowed as deduction. But one thing to be taken care of, expenditure shall not be capital expenditure. For example, if I am earning something, and I buy, if my business is not renting of plant and machinery, whatever my earning from renting of plant and machinery is taxable under IFOS. But I bought a bike just to collect the rent. For that matter, does the expenditure incurred on acquiring bike or buying bike will be allowed as deduction under section 57? Right answer is no. Simply no, because that is a capital expenditure. But yes, depreciation will be allowed. If that bike is solely used for collecting rent from plant and machinery, then depreciation on that plant and machinery will be allowed. So what I am saying, any expenditure wholly or exclusively incurred to earn such expenditure will be allowed as deduction. Then section 58 says what all expenditures will not be allowed as deduction. First of all, any kind of personal expenditure incurred will not be allowed. Any kind of personal expenditure will not be allowed. Second thing, if you are paying any money to an outsider, to a person outside India, and which was liable to be TDS, which was liable for TDS, and you did not deduct TDS on that. It was liable for TDS and you did not deduct TDS, then it will not be allowed as deduction at 100%. 100% will not be allowed. Third thing says, if you are paying any sum greater than 10,000, you have to pay it by banking channel, either by account pay check, account pay demand draft, or any clearing system. If you paid in cash, then it will not be allowed as deduction. Any expenditure relating to casual income will not be allowed. Any income, any expenditure relating to casual income will not be allowed. Sir, for example, I won lottery, and for that lottery, I have paid many brokerages, I have paid many bribes. Will it be allowed as deduction? Right answer is any income, any expense relating to casual income will not be allowed. And last but not the least, says any income, any expenditure which was liable for TDS, which was liable to TDS. You are paying any expenditure to a resident which was liable for TDS, and you did not deduct TDS, or even if you deduct but you did not pay TDS to the government, 30% of such expenditure will be allowed. So what I said, 5 under section 58, following deductions will not be allowed as expenditure. Following expenditures will not be allowed as deduction. First of all, any personal expenditure will not be allowed, any capital expenditure will not be allowed, any payment which was liable for TDS to a non-resident, you did not deduct TDS, then 100% of that expenditure will not be allowed. Any payment to resident which was liable for TDS, you did not deduct or did not pay to government, 30% will be disallowed. Or any income that any expense on account of casual income will not be allowed, or any payment made greater than 10,000, that too in cash, will not be allowed. Last, it was a case law. Manju and Company was dealer of lottery tickets, was dealer of state lottery tickets. One day they were not able to sell their complete tickets. For that matter, one of the leftover tickets gave them 1 CR lottery. Manju and Company claimed that since our business is of lottery, so this lottery winning shall be taxable under that PGBP. Right answer is Kerala High Court said. Kerala High Court said that even though your business, even though your business is of lotteries, but this income will always be treated as casual income. This income will always be treated as casual income. It will be always taxable under the winnings head, or I should say income from other sources. Your business was to sell the tickets. Your business was to sell tickets. Your income cannot be from winning lottery. Your income can be from commission from your income can be only from commission from the sale of the lottery. Therefore, this will be taxable under the head winnings income. I'm giving you break of 15 minutes. Do take break wisely. Do not use mobile phone. We'll see you guys after 15 minutes. After that, we'll study PGBP chapter. Our focus will be on PGBP. If you have any doubt in IFOS, I will be there for you. You can message me on Telegram, WhatsApp. You can give a phone call to me. I will be replying. See you guys after 15 minutes. Take break wisely. Welcome everybody from the break. How did you use your break? Using Instagram, WhatsApp, or any other mobile phone application? Or listening to music? I want an answer from all of you. See, wherever you use your break, I want all of you to use it wisely, because you have to sit here for 3.5 hours. And to maintain the productivity, breaks are really very important. These breaks are intentional. Otherwise, I can take this session in one go. But I want break, and I want all of you to have breaks so that your productivity is maintained throughout. So I hope you are understanding what I am saying. Got it. So, sir, before going to break, we were done with the chapter IFOS. Now we have to start the next chapter, profit and gain from business and profession. Before starting, all of you, tell me, what was the charging section for capital gain? What was the charging section? Sir, we do remember section 45. What was the charging section from income from other sources? Sir, section 56. What was the charging section for house property? So section 22, and charging section for salary was section 16. Similarly, we have a charging section in PGBP. So section 28, it says, following income shall be taxable under the head PGBP. All these listed items will be taxable under the head PGBP. Sir, what incomes? Any profit and gain arising from business and profession carried out by the SSC during the previous year. Even for 1 day, even for 1 month, or even for a whole year, if SSC carries out any kind of business or any kind of profession, such income from such business will be taxable under the head profit and gain from business and profession, or PGBP acronymically. Simple, any business gain, as simple as it can be. Sir, any salary, interest, bonus, commission received by partner from the partnership firm to the extent allowed to partnership firm. See, whenever partnership firm pays any kind of interest to partners, that interest is allowed to the extent of 12% as deduction, and remuneration to the extent of 90% and 60% is allowed to partnership firm. If it is allowed as deduction to partnership firm, that means firm has not paid taxes on that. So that similar amount will be taxable in the hands of partners, and it will be taxable under that PGBP. Whatever deduction the firm has claimed on interest or on remuneration will be taxable to the hands of partners under the head PGBP. Third thing says any amount received on account of Keyman insurance policy. We have been studying this Keyman insurance policy thrice. While studying ULIP, we studied Keyman insurance policy is taxable under PGBP. While studying IFOS, we studied Keyman insurance policy, if not taxable under PGBP, will be taxable under IFOS. Sir, what is Keyman insurance policy? For example, Reliance insures Mukesh Ambani. Reliance today works on Mukesh Ambani, on the directions of Mukesh Ambani. What if Mukesh Ambani died? What if Mukesh Ambani died? Who will bear the losses? Reliance will from here to here. For that matter, every company insures some of its key managerial personals with Keyman insurance policy. In any maturity, any money received on account of Keyman insurance policy, since it has been done by the business, it will be taxable under the head business head. Sir, any grant subsidy received from the central government relating to any business or profession, any grant or subsidy. Sir, for example, many a times people who run schools, many grants are received by the government in the form of books, in the form of cash assistance. Any such grant received will be taxable in the hands of school as business and profession. Assuming that school is not a non-profit organization, it is a profit-making organization, any grant received by them will be considered as business and profession. Sir, any gift perquisites received due to business and profession, whether convertible into a cash or not. Sir, for example, my father is an FMCG dealer. My father is a FMCG dealer. He is a wholesale dealer of Hindustan Unilever. He resells the product, buying from agency and selling it to different retailers and different consumers. Many a times, my father receives a kind of scheme that if he makes sales of rupees 5 lakh a month, if he makes sales of 5 lakh a month, he will be awarded a trip to Thailand. That trip to Thailand is because of business relationship. Therefore, that value of such trip will be taxable under that PGBP. Many a times he receives a scheme where by making sales of 10 lakh rupees, he will be awarded a gold chain of rupees 10,000. Any such gift, any such gift received on account of business relationship will be taxable under the head PGBP, whether it is convertible into cash or not. For example, Thailand trip is not convertible. Either he can use it or either he cannot use it. If he does use it, then it will be taxable under that PGBP. Sir, FMV of stock on conversion into capital asset. Sir, what if I have told you, if we have a capital asset, like my mother had saved gold from her childhood just for my benefit, so that was capital asset. But when I received that gold, I required that gold for business purpose, so I converted such capital asset into stock in trade. What was capital gain implication at the time of conversion? Sir, FMV was considered as sales consideration and cost of acquisition was reduced and capital gain was fixed at the time of conversion. Now, whenever this stock in trade was sold, then capital gain was leviable in my hand, and whatever income was accrued after the conversion of such stock in trade, then it was taxable under PGBP. What if I convert such stock in trade again to capital asset? Is it possible? I'm shutting down the business, again it will be converted as capital asset. Then what provision says conversion of stock in trade into capital asset on the date of conversion? On the date of conversion, FMV minus FMV on previous conversion will be taxable under the head PGBP. When a stock in trade is converted into capital asset, FMV on the date of such conversion will be treated as PGBP income. Did you get this point or not? Yes, sir, we did understand. There is no issue in that. Sir, next point. So any kind of export assistance like cash assistance, duty drawback, and import entitlement, any kind of such sale will be PGBP income. So non-competition fees for not carrying on any business. For example, I am having a sweet shop and Haldiram's also arrives at the same place and wants to open an outlet. Now Haldiram's pays me 10 lakh rupees for not doing any business. Any such fees received by me will be taxable under PGBP. Or for any fees paid for not sharing any intangible asset will also be taxable under that PGBP. Any income derived from the trade association, I want you all to keep it on hold because this will be studied under section 44AA later on. 44 single, yes. Sir, there is also a kind of business called speculative business. It is a kind of business where you buy or sell shares or commodities without actually taking physical delivery of that commodities or shares. All in all, I can say if you are doing intraday trade without any delivery, you are buying and selling such properties, such shares or commodities. Such trade is called speculative business. Any gain arising from such business will be speculative business. Sir, what will be treatment of speculative business? It will be treated as normal business. It will be treated as normal business, taxable as normal business, but losses of such business can be set off against the speculative business only. You cannot set off business losses from any other businesses. So speculative business losses can be set off against only speculative business. Rest all treatment will be same. Sir, what kind of businesses are speculative? Simply you can say intraday trading of shares and commodities, or if you are asked definition, then purchase and sales of shares and commodities without actually taking delivery of the shares and securities. Got it? From the above definition, can I say a few businesses will be considered as speculative? For example, hedging contracts will also be speculative. For that matter, provision lays down certain relaxations. It says the following businesses will not be treated as speculative. Sir, these four businesses that are mentioned in these boxes will not be treated as speculative business despite of the fact that they fall under the definition. What are those businesses? Are hedging contract for raw materials. So if you are doing a hedging contract for raw material, it is necessary now. It is necessary to protect your revenue. It is necessary to protect your losses. So for that matter, you are hedging. Will that be considered as speculative? Right answer is if you are hedging for raw materials, it will not be treated as speculative. Any kind of forward contract. For example, I am entering a forward contract for 3 months later to buy any kind of currency. Any kind of forward contract will not be considered as speculative. Any kind of trading in derivatives. If you are trading in futures, if you are trading in options, sir, if you are trading in derivatives on recognized stock exchange, it will never be treated as speculative. And last but not the least, any trading, any derivative trading in commodities, any derivative trading on commodities on recognized stock exchange on which commodity transaction tax is paid will never be treated as speculative business. And even some of the agriculture commodities that you trade, even if you don't pay CTT, then too it will not be treated as speculative business. Got this point? So every intraday business is speculative business, but these four business, despite of having nature like intraday business, these are not speculative business. What are namely? Hedging business, hedging contract for raw materials, forward contracts, derivative trading on recognized stock exchange, and commodity trading on recognized stock exchange, commodity derivative trading on recognized stock exchange, that to CTT has to be paid. But even in case of agriculture commodities, if CTT is not paid, still it will be treated as non-speculative business. Got this point? So section 20 and how to compute PGBP. So how to compute PGBP? Very simple. Consider the provisions of section 30 to 34, 30 to 43. Consider the provisions of section 30 to 43D. It will help you out how to calculate PGBP. For that matter, just move on to section 30. What it says. So rents, rates, taxes, repairs, insurance paid for building. Sir, any kind of rent. If you are paying rent for the building, sir, will it be allowed? If you are a tenant, it will be allowed. But if you are landlord and you are paying rent for your own building, will it be allowed? Right answer is no. So rent paid is allowed always, but it will not be allowed to owner. Any kind of rates, taxes paid, will it be allowed? Right answer is yes, it is be allowed. Any kind of repairs, insurance done on the building, sir, it will be allowed. But make sure that you are not doing any capital repairs. Sir, any capital repairs will not be allowed. Every kind of revenue repair will be allowed. Sir, capital repair, for example, if you are constructing a building and you constructed another floor, you want to capitalize, you want to treat it as revenue expenditure, it will not be allowed. Got this point? Rents allowed to everybody but not to owner. Rates and taxes always allowed. Repairs, revenue repairs allowed. Capital repairs not allowed. And insurance always allowed. These are few things. Next point. So rents, repairs and insurance of plant and machinery. So if you are paying rent on plant and machinery, always allowed, but not to owner. It is very much understood. Sir, if you are paying repairs, revenue repairs allowed, capital repairs not allowed. Sir, in case of any insurance, it is always allowed. Rent paid to partner is allowed. Sir, for example, if a partner has lent out you a plant and machinery, and you are paying if you are paying rent to partner, if you are paying rent to partner, will it be allowed as deduction? Right answer is it will be allowed, but it has to be reasonable. For example, from lending such property, lending such plant and machinery from market is available at 10 lakh rupees, and partner lends you at 20 lakh rupees, then 10 lakh is unreasonable now. So 10 lakh unreasonable will be disallowed by the assessing officer. This was all about. These were basic sections. I don't think any question will be asked on these topics. Next one is important. I should say not important, but it is lengthier, and I would expect to complete this topic today itself. I expect to complete this topic today itself, because tomorrow we have to complete remaining PGBP. Tomorrow we have to complete remaining PGBP. Got this point, sir? Yes. Yes, sir, we did understand. Section 32, depreciation. So whenever you want to claim depreciation, you have to use that asset for business and profession. And second thing, you must understand that you have to be owner of that asset or the beneficial owner of that asset. Either you have to be owner or you have to be beneficial owner. Beneficial owner is the person who pays the consideration. You have to be owner of that asset or you have to use that asset for business and profession. Sir, what example? What if in case of lease agreement? Sir, lease agreement we have two parties, lessor and lessee. Lessor the one who gives the asset on lease, and lessee the one who receives the asset on lease. Who will be allowed depreciation? Right answer is lessor will be allowed. And what deduction lessee will be getting? Lessee will be getting deduction of rental payment or lease payment, because lessee will be paying rent now. Lessee will be paying rent. He will be getting deduction for rent payment, and lessor will be getting deduction for depreciation. This is the arrangement in case of leases. Whenever we are studying depreciation in case of income tax, for the purpose of income tax, depreciation is allowed on the assets from the date they are put into use in the business. Depreciation is never allowed when asset is ready to use. It is always allowed in case asset is put to use, whenever you put such asset to use. But a few assets, there are three exceptions which are allowed from ready to use date. There are three assets on which depreciation is allowed from ready to use date. So what are those assets? First of all is standby equipment. For example, there is camera in front of me. This asset is used in my business, so depreciation on this camera will be allowed. But I do have a backup camera in my drawer. I require a backup camera whenever this will not be working. What will I do? So for that matter, I require a backup camera. And for that matter, that backup camera will also be eligible for deduction or eligible for depreciation, even if it is not in regular use, because it is a standby equipment now. It is a standby equipment. Or any kind of fire extinguisher. Who will require to wish fire extinguisher? But I have kept it in at my house, at my premises. I have kept that fire extinguisher. Who wants to use that fire extinguisher? Nobody wants to use such fire extinguisher. So even if you have a fire extinguisher, you never use it, you will still be eligible for exemption. That is, you will be allowed a depreciation from ready to use it. And machine server, for example, we have extra machine servers that will also be eligible for depreciation. So what I said, depreciation is allowed from ready to put to use date, but in three cases it will be allowed from ready to use case. What are those three cases? First of all, mobile depreciation on standby equipment, machine servers, and last one is fire extinguisher. At this point, yes, sir. Sir, what if I don't want to charge depreciation? I want to increase my profits to the fullest. Can I do so? Right answer is depreciation is a mandatory charge. You cannot escape depreciation. You have to have depreciation. You need to have depreciation. It is a mandatory charge. Did you get this point or not? Sir, what if I have a plant and machinery that is partly being used by me and partly being used by any other businessman? I have a plant and machinery that is partly being used by my business and partly being used by another business. So for that matter, only your portion of that machinery will be eligible for depreciation. For example, if I have a machinery for 10 lakh rupees and I use it 50%, so whatever depreciation will be calculated on the 10 lakh rupees, only 50% of that will be allowed to me and rest 50% will be allowed to the co-owner. Sir, two things to be taken care. Depreciation is not allowed on land and goodwill, because land is not a depreciable asset, and on goodwill it has been removed from Finance Act 2021. So what five things I told you, sir? You have to use it for business. Second thing, you should be owner. Next thing, in case of lessor lessee, I told you depreciation is allowed from put to use date, but in three cases that will be allowed from ready to use date. It is a mandatory charge. If you are using asset in co-ownership, then only your share of depreciation will be allowed to you. And last one is depreciation is never allowed on land and it is never allowed on goodwill. Now we have to understand how to calculate depreciation. In income tax, you must understand, in income tax, depreciation is calculated on WDV basis. WDV method is followed, that to not an individual asset system, on a block of asset system. For example, a class of asset has different rates, so every class along with every different rate merged together forms a block. For example, every building who has 5% depreciation will be a block. Every building who has a 10% depreciation, it will be a block. Every plant and machinery that is chargeable to 15% rate will be a block. So a category of asset along with falling under the same rate will be a block, and all the assets in a block will be merged and depreciation on whole block will be charged. This is the concept of block of asset system. Depreciation in income tax is applicable on WDV method on block of asset system. No SLM, no single line, no straight line method, no single asset system. Block of asset system, that is a block of assets, and WDV method. Sir, what is the rate of depreciation? For that matter, you need to understand how asset classes have been determined in income tax. Sir, for tangible assets, we have three class. Building is one of the class. Furniture is the other class, and plant and machinery is the other class. Fourth class is intangible asset, which includes all the intangible assets. We have four classes. Complete structure of assets have been divided into these four categories, these four classes. Of these four classes, these classes have been subdivided into different blocks. For example, class 1 building includes a residential building, which will be chargeable to tax at 5%. Sir, other building, for example, commercial building or general building, sir, it will be chargeable to 10% tax, 10% depreciation. And sir, temporary structure or wooden structure, it will be chargeable to 40% depreciation. In this case, sir, for example, in building, we have different categorization of rates. For different category of buildings, different depreciation rates have been prescribed. So any building falling under the same depreciation rate will be considered as a part of block, and depreciation on whole block will be charged as a whole, not on individual asset it will be charged. Got this point or not? Sir, class 1 building, residential building 5%, other building 10%, and wooden building 40%. We have second class called furniture. Sir, any kind of all kind of furniture, including electrical fittings, for example, any kind of wires that we have, any kind of boards we have, any kind of lights we have, sir, it will be considered as furniture. Sir, along with that, wires or any kind of switches will be chargeable to depreciation at the rate 10%. Even if, sir, we have roads, sir, we have tube wells, these are chargeable under the head building. Depreciation is chargeable on these roads or buildings under the head building. So third class is plant and machinery. Plant and machinery is to be taken with due care, is to be studied with due care. Sir, why due care? Because in plant and machinery, we have different options. The first one is 40% depreciation category. These six assets are categorized under 40% category. Planes and aero engines. Aeroplanes and aero engines. First of all, that is to be categorized. Second thing, sir, computer and software programs. Computer includes any kind of printer, any kind of scanner, any kind of UPS. These two are chargeable to 40%. Sir, any kind of books or annual publications, also 40%. Any kind of pollution control equipments, any kind of renewable energy device, for example, solar panel or electrical vehicle, or any kind of medical equipment, for example, measuring blood pressure machine or diabetes machine, measuring diabetic machines, is also chargeable to 40%. So what did I say? Six asset I said will be chargeable to 40%. Sir, aeroplane, aero engines, books, then we have computers, including UPS, including printer, including scanners, pollution control devices, renewable devices, and medical equipments. These are chargeable to 40% rates. Apart from that, sir, any kind of boat, ship, vessel will be chargeable to 20% tax rates. This is second block. And third block will be 15%. Sir, any kind of normal motor vehicle, any kind of oil well, any kind of office appliances, any kind of mobile phones, sir, any kind of EPABX telephone that you used to have in olden times, sir, mobile phone, EPABX, and any kind of other plant and machinery will be chargeable under 15% depreciation rate. Thing to be taken care is, sir, if we have a laptop, it will be chargeable to 40% tax rate, but if we have mobile, it will be chargeable to 15% depreciation rate. These two differences are to be taken care. If I have a UPS, since it is associated with 40%, it will be chargeable to 40% depreciation. But if we have a charger for mobile, it will be chargeable to 15% because charger is of mobile. At this point or not. So these are the depreciation rates. So for plant and machinery, we need to take care. So what care has to be taken? If you are having any regular business, for example, I have a FMCG business. It is a regular business, normal business. So normally plant and machinery is chargeable to 15% depreciation. But if plant and machinery is acquired from 30th August 2019 to 31st March 2020, that means in the period of, I guess it was 7 months. If you have acquired such plant and machinery in that intervening 7 months from 30th August 2019 to 31st March 2020, then depreciation rate will be 30%. Similarly, sir, if you don't have a regular business, but if you have a business of renting of motor vehicle, If you have a business of renting of motor vehicle, then normally depreciation is 30% allowed. But if such plant and machinery is acquired from 31st August 2019 to 31st March 2020, then depreciation on that plant and machinery will be 45%. Got this point or not? Got this point or not? Yes, sir, we did get this point. We did get this point. Next. So if you are having any windmill, and windmill was installed before Modi government coming into power, sir, first April 2014, then it will be chargeable to 15% depreciation. And as soon as Modi government comes into power, depreciation on windmill is increased to 40%. But this point or not, sir? So this was all about plant and machinery. We have fourth class as intangible assets. It will be chargeable to simply 25% tax rate. Simply 25% tax rate. Got this point? Are Baba got this point? Yes, sir, we did understand. Sir, repeat after me. I want you all to repeat after me. Sir, any kind of building, any kind of, sir, residential building, 5%. Any kind of commercial building, 10%. Wooden structure, 40%. Then we have any kind of furniture, including electrical fittings, including wires, including switches, it will be taxable at 10%, depreciable at 10%. Any kind of plant and machinery is a 40% one. We have aeroplanes, aero engines, we have books, we have renewable devices, we have pollution control equipments, we have medical equipments, we have computers, including UPS printers and scanners will be chargeable to depreciation at 40%. We have ships, motorboats, or we have speedboats, 20% depreciation. Then we have 15% plant machinery, a normal water vehicle. We have normal other equipments. We have mobile phone EPA BX chargeable to 15% depreciation. Now, for motor vehicle, we have studied that if motor vehicle is acquired, normally it is 15% depreciable. But if it is acquired from 31st August 2019 to 31st March 2020, it will be chargeable to 30% depreciation. Vice versa, if you have a business of motor vehicle, renting of motor vehicle, then normally 30% depreciation is allowed. But in case you have acquired between 31st August 2019 to 31st March 2020, it will be chargeable to 45% depreciation. If you have a windmill acquired or used, acquired and put to use before Modi government coming into power, that is 1/4/2014, then it will be depreciable at 15%. Otherwise, after that, it will be depreciable at 40%. Then any kind of intangible asset will be depreciable at 25% category. Did you get this point or not? Did you get this point or not? Yes, sir, we did understand. We did understand what you are saying. So depreciation on the asset shall be allowed on WTV on block of method as prescribed. Sir, on a single asset is not followed, we'll form a WTV where all the classes, all the assets which are from the same class plus same rate will form part of this block, and this block we'll be reducing depreciation from this block as the rate prescribed. Block implies same class of asset and same rate of depreciation. So we have an proviso to this. Power generating and distributing SSC have an option not to opt the block method. They have to follow WTV method, but they can opt for individual asset system, not to opt for block method and opt for individual asset system on straight line basis. Every other SSC shall follow WTV on block method system. That is, power generating unit have an option either not to opt WTV and block method system. They can simply opt straight line method on a single on individual asset system. They can opt for straight line method on individual asset system. They have option. They can still go for WTV method and block of asset method, but still they have an option to opt for straight line method into individual asset system. This was all about rates of depreciation. Now, calculation of depreciation, that is really very important topic. How to calculate depreciation? How to calculate depreciation? So simply, whatever the opening block was, so simply depreciation is to be calculated block wise. If we have 10 blocks, then depreciation for all the 10 blocks will be calculated differently. All the 10 blocks will be calculated differently. I'm talking about how to calculate depreciation of a block. Sir, first of all, take the opening WTV, whatever the opening WTV was there. Then you have to add all the assets that are acquired during the year. You have to add all the assets acquired during the year, but you have to add in 3 stages. Any asset that is acquired and put to use for more than 180 days or more. Any asset that is acquired and put to use for 180 days or more, sir, will be added differently. Sir, any asset that is acquired and put to use for less than 180 days, that is on or after 5th October. I have done this homework for you. If you have acquired on or before 4th October, then it will be for more than 180 days. If you have acquired on or after 5th of October, then it will be for lesser than 180 days. I have done this homework for you. And third part will be any asset that is purchased but not put to use. Any asset that you have purchased and not put to use, all these three assets will be added differently and it will give you all the assets acquired during the year. Then any kind of sales made or asset discarded, sold, demolished. For example, we had an asset. That asset got sold during the year, sir. Any kind of sale price will be reduced. Whatever sale price we are receiving will be reduced from such block. Any kind of asset that is discarded will also be reduced. If asset is demolished, then also whatever insurance is being received, that will be reduced. Ultimately, whatever the money that you are receiving on transfer of such capital asset will be reduced. Even if you have if you are scrapping such asset, whatever the money you are getting from that kabadi wala will be reduced. Simple. This will be reduced. So in case you are transferring any asset in the slum sale, for example, a slum sale has undertaken in your organization and some assets that were forming part of the block are also transferred in the slum sale. How will such asset be reduced? You have to assume that these were the only assets in the block. Assume there were no other assets in the block. Then what would have been the value of block? For example, there were 5 assets in the block, 5 assets. And we have block of say 50 lakh rupees. So ignore this block of 50 lakh rupees. You have to consider if these two assets were transferred in slum sale, then assume only these two assets were only forming part of block. Assume only these two assets were part of the block and charge depreciation accordingly and bring it to the opening WDV and find out what would their value would have been if these assets were the only part of the block. For example, if these were only assets forming part of block, our WDV would have been 20 lakh rupees. Then 20 lakh has to be reduced from this block and 30 lakh will be our sales remaining value. 20 lakh has to be reduced here, sales at the time of slum sale. Got this point or not? Got this point or not? Sir, got this point. What was there? We already know this point. See, some things now I have to presume that you already know. We are revising things, so we have to be on time. I cannot wait for every topic to be stretched as regular batch. We are revising these things, so these things have to be a bit faster. So I really expect from all of you to have a bit more grasping capacity. Got this? Okay, sir. Okay. After reducing the selling price, whatever we have arrived will be WDV for depreciation calculation. This is the WDV for depreciation calculation. Now I have to reduce depreciation actually allowed. So, sir, how depreciation will be actually allowed? Sir, whatever WDV you have calculated, sir, bifurcate into 3 parts. Sir, assets that are acquired but not put to use. Sir, no depreciation will be allowed. Sir, acquired and put to use for less than 180 days. Sir, whatever depreciation rate we have studied, sir, 40%, 15%, 10%, 5%, half a rate depreciation will be allowed to those assets. And sir, balance WDV, whatever remains, sir, full depreciation will be allowed. Very simple concept. Sir, you have studied this in depth in intermediate. I'm expecting that thing. At least I'm expecting that thing. But still, we are studying from the scrap only. Sir, if any cost is directly attributable to installation of plant and machinery, for example, you are paying any brokerage, you are paying installation charges, you are paying any kind of freight charges to bring that plant and machinery to your premises, that cost will form part of your cost of asset or block of asset. Section 43A actual cost will be discussed later. Sir, if there is any sale, then sale value has to be reduced. Even if you are doing sale at a very lower value, if you are doing sale at a least value, then to sir, sale value will be reduced. But if there is capital gain arising on such asset, then you have to reduce. Then for capital gain purpose, SDV will be reduced. What I am saying, focus. I have a block of asset. I did sell any of the asset from that block. Then at the time of sale, what amount has to be reduced from block? Actual sale value is to be reduced. Even if you are selling it for 1 rupee, sir, 1 rupee has to be reduced from block. You are selling for 50 rupees, sir, 50 rupees to be reduced from block. You are selling for 1 million rupees, 1 million rupees have to be reduced from block. Actual sales value is to be reduced. But for calculation of capital gain, SDV, WDV will be used. Got this point or not? Did you get this point or not? Yes, sir, we did understand what you are saying. We did understand. For calculation of capital gain, SDV will be used. For example, you are selling any building, SDV will be used. But for the purpose of reducing amount from the block, actual sales value is to be reduced. You have to take care of that thing. And last, the most important point, for example, I want you all to focus on this example. For example, I bought asset in previous year 23-24. Sir, I bought that asset on 1st January 2024 and sir did not put to use. Not put to use. Now tell me whether depreciation will be allowed in that assets. Whether depreciation will be allowed on those assets. Right answer is sir, since you did not put to use asset, no depreciation will be allowed. Now what if you put to use asset on 1st April 2025? That is asset acquired in previous year 23-24 is put to use in previous year 24-25, 24-25, and that too for lesser than 180 days. Acquired was in previous year, but is put to use in next year. Asset is put to use in next year, and that too for 180 days, that too for lesser than 180 days. Will full depreciation be allowed or half depreciation be allowed? Will full depreciation be allowed or half rate depreciation be allowed? Right answer is in this case, full depreciation will be allowed. So, sir, what do you mean? What I mean is if asset is acquired in a year and not put to use for less than 180 days, in that year itself, in that case, half rate depreciation will apply. But otherwise, if asset is acquired in any of the previous year and not put to use in that year, and is put to use in next year, then full rate depreciation will be applied. All in all, that provision of half rate depreciation was for those assets that are acquired and put to use in the same year, and that too for 180 days or less, or less than 180 days. But if asset is acquired in any of the prior previous year and put to use for less than 180 days in subsequent years, for that matter, full rate depreciation will be. Like if you read this, you will get a better idea what it says. If asset is bought in previous year 23-24 and not put to use in previous year 23-24, no depreciation will be allowed since asset is not put to use. If asset is bought in previous year 23-24 and not put to use in previous year 23-24, but put to use in previous year 24-25 for a period less than 180 days, then full year depreciation shall be allowed. That is, half rate is applicable for the year of acquisition. Half rate will be applicable only for year of acquisition. For subsequent years, full rate will apply. Got this point or not? This was all about calculation of depreciation. I hope things are getting a bit more clear in your brain. Sir, what if we sell those assets? What if we sell those assets? Sir, what if we sell those assets? What to do? What if we sell those assets? We have a different concept altogether for those. We have a different concept for all those. What does it say? What does it say? Sir, if all the assets in a block are sold, you have to bifurcate. If all the assets of the block are sold, or if all the assets of the block are sold and WTV becomes negative. For example, sir, we had two assets in the opening worth rupees 1 lakh, and we bought three assets more worth rupees 2 lakh. Our block turns out to be 3 lakh rupees, and such whole of the five assets we sold for 4 lakh. Our WTV was 3 lakh for five assets. Whole five assets are sold for 4 lakh. That means, can I say that we have gain? We had value of 3 lakh rupees and I sold it for 4 lakh. Can I say we have a gain? So gain will be short-term capital gain. Any gain on depreciable assets will be short-term capital gain. Got this point or not? Any gain arising from short-term capital gain on depreciable assets will be short-term capital gain. Sir, what if all the assets are transferred but WTV turns out to be negative? For example, sir, we had two assets worth rupees 1 lakh. We added three assets worth rupees 2 lakh rupees. I sold all these five assets worth rupees 1 lakh. So WTV was 3 lakh, but I sold it for 1 lakh now. So there must have been some loss. That loss will be short-term capital loss. This is the case when all the assets of the block are sold. But what if, sir, not all the assets are sold? In ordinary course of business, not all the assets are sold. Only a few assets are sold. Provision says if not all the assets are sold, then whether WTV becomes negative or not. Provision asks you a question, whether WTV becomes negative. If the answer is yes, sir, WTV becomes negative, then I can say that it is short-term capital gain. For example, if I had two assets in the beginning worth rupees 1 lakh, I bought three assets worth rupees 5 lakh, worth rupees 2 lakh. My WDV turns out to be 3 lakh for 5 assets. Can I say now these 3 lakhs assets worth 3 lakh assets? I mean 5 assets worth rupees 3 lakh. Out of these 5 assets, I sold 2 assets worth rupees 5 lakh. Can I say my WDV turns out to be negative? Just focus with me what I'm saying. Focus with me. Can I say I had 5 assets worth rupees 3 lakh? Out of those 5 assets, only 2 assets I am able to sell for 5 lakhs. That means can I say 5 assets worth rupees 3 lakh, and I'm able to sell 2 assets worth rupees 5 lakh. That means too much of gain I am occurring, too much of gain I am earning. In that case, it will be chargeable to short-term capital gain, and remaining WDV will be useless. Remaining assets will be useless because you do not have any WDV left now. You have charged depreciation, you have claimed all WDV, and you have also claimed the capital gain. So remaining assets becomes useless. In that case, since we are selling at a profit, it will be short-term capital gain. What if, sir, not all the assets are transferred and WDV is still positive? That means we still have amount left in WDV. For example, we have 2 assets worth rupees 1 lakh. We have 3 assets bought worth rupees 2 lakh. Ultimately, we have 5 assets worth rupees 3 lakh rupees. I sold 2 out of these assets worth rupees 2 lakh. So our WDV continues to be 1 lakh. And remaining assets are 3 lakhs. So depreciation will continue to follow. There will be no capital gain and WDV will continue to follow. NOA, whatever I have written is number of assets. Block can be 0 but can never be negative. As soon as it implies negative, it implies short-term capital gain. As soon as you see negative block, it implies short-term capital gain. This was all about calculation of capital gain in case of depreciable assets, in case of block of asset system. Really, really very important. I want you all to draw a skull here. A danger skull, a danger indicating skull. A danger indicating skull, angry skull. Because most of the times when you see this topic, additional depreciation, you tend to forget what we have studied. You tend to forget, there are minute details that you tend to forget, and even if you remember while computing total income, you tend to forget the additional depreciation adjustment to be made. You tend to forget. For that matter, I want you all to draw the skull on this topic because, sir, because many a times question gives you that entity is a manufacturing entity. Entity is a manufacturing entity, and even though tax is to be calculated as per old tax regime, tax is to be calculated as per old tax regime, you tend to forget to give the adjustment of additional depreciation. For that matter, I want you all to remember this by heart, that whenever you see manufacturing entity and taxes to be calculated as per normal provisions of Income Tax Act, then for that matter you have to give impact of additional depreciation. So if an SSC is engaged in manufacturing production of any article, either he can be a manufacturer, he can be a production of any, he can do any production of any article. So printing and publication will also be considered as manufacturing. Sir, he is engaged in generation, transmission, and distribution of power. Generation, transmission, and distribution of power. Then additional depreciation at the rate 20% is allowed on the plant and machinery satisfying the following condition. Then whatever plant and machinery he is acquiring, he will be entitled to 20% of additional depreciation on such plant and machinery. So there has to be 4 conditions to be complied. Sir, what are those 4 conditions? Sir, plant and machinery should be new. Sir, no second-hand plant and machinery should be allowed. No second-hand plant and machinery should be allowed. Sir, if plant and machinery is put to use for 180 days or more, then 20% depreciation will apply. But if it is put to use for less than 180 days, only 10% will depreciation you will be allowed, and balance 10% will be allowed in next year. If plant and machinery is new, complete 20% if used for 180 days or more. But if used for less than 180 days, then half rate depreciation will be allowed. That is 10% depreciation will be allowed, and balance 10% will be allowed in the next year. So the plant and machinery should be installed in factory premises, sir. You cannot use plant and machinery in office, not in residential accommodation. You cannot use such plant and machinery on factory premises, office and premises or residential accommodation. The third condition, SSC should not claim 100% deduction on such plant and machinery. Sir, for example, there are many businesses which are entitled for 100% deduction. For example, businesses that are doing research, businesses that are doing 3580 businesses, or if you are doing any skill development project under section 8035 CCD, whatever capital asset you are acquiring, you are entitled 100% depreciation on those assets. For that matter, you should have not claimed 100% depreciation on such assets. Then only you are entitled for additional depreciation. And last thing, additional depreciation is not applicable on ships. If you are buying any ship, not applicable. If you are buying any aircraft, not applicable. If you are buying any transportation vehicle, not allowed. But it is allowed in case of forklift trucks used in factory. If we have any forklift structure, the forklift, what are forklift truck? The trucks that are used to carry the loads. Those forklift trucks are allowed 20% additional depreciation when bought and put to use for 180 days or more. This was all about additional depreciation. Got this point or not? Got this point or not? Got this point or not? The next point. Till now we have studied na ki we have to add it to WTV. We have to charge depreciation. We can charge additional depreciation. If we sell, we have capital gain. Sir, what to add in WTV? What is to be added in WTV, sir? What is to be added? Sir, amount is to be added which section 43(1) provides. Sir, actual cost of asset has to be added on the WTV, not any amount as per your will you can add. Any kind of expenditure that you make, you cannot add it to WTV. Only the items given under section 43(1) will be allowed to be added to actual cost of asset, and you can claim depreciation on that amount only. Sir, what section 43(1) says? It says any purchase price, that is amount paid to vendor, that is to be added in cost. Sir, any installation charges, transportation charges, any trial tests and expenses has to be added. Any taxes and duties if ITC is not available. Any taxes and duties, sir, ITC is not available. For example, GST on which ITC is not available. For example, if you are buying a motor vehicle, sir, motor vehicle ITC is not available. It is a block credit. It is block credit as per section 17(5). See, you get revision of GST also along with income tax. See, if you are buying any asset on which ITC is not available, that ITC part will also form part of block of asset. You have to reduce any kind of government grant subsidy received for the acquisition of the asset. If you are acquiring any asset, if you are receiving government grant or subsidy for such acquisition, then such subsidy or government grant will also be reduced from cost of acquisition. And last thing, any amount received on sale of trial run product. For example, I led a manufacturing. I set up a manufacturing. I operated a manufacturing unit for soaps. For that matter, I did some trial runs in which I manufactured certain pieces of soap. All those trial and expenses will form part of block of asset. But what if these soaps that are made in trial run are being sold and I earn some money from it? What if these trial run products are being sold to an outsider or any of the person and I earn some money on that? Any amount received on such sale of trial run products will be reduced from cost of asset and balance amount will be added to cost. Also, one thing to be taken care of. While paying any sum to vendor or installation charges or transporter or trial expenses or duties, no amount greater than 10,000 rupees shall be paid by cash balance. That means you have to either pay account pay check, demand draft, or electronic clearing system. You have to pay any sum by account pay check, account pay demand draft, or electronic clearing system. You cannot pay any sum via cash method or cross check or bearer check. Got this point or not? Yes, sir, we did understand. If you pay any sum greater than 10,000 via check, via cash, via cross check, via bearer check, then such expenditure will not be allowed as deduction. That such expenditure will not be added to cost of the asset. Did you get this point or not? Did you get this point or not? Yes, sir, we did get this point. This was cost of acquisition in special cases. People tend to do dimag. People tend to use their brain too much to increase this cost of acquisition so that higher depreciation can be claimed and lower taxes can be paid. People tend to increase such cost of acquisition. For that matter, we have to study cost of acquisition in case of special cases. Sir, what special cases? Tell now. What special cases? Do tell. So first of all, if any asset is used into scientific research and bought into regular business. Sir, if asset is used in scientific research and that is bought into regular business. Sir, what happens when an asset is used in scientific research? Sir, asset is entitled for 100% deduction, 100% depreciation. Whenever you buy an asset that is used in scientific research, you get 100% deduction, 100% deduction for such assets. Now, if you have already claimed a depreciation on that asset, if you transfer it to regular business, will that depreciation be allowed again? Right answer is no. You have already claimed 100% reduction in one of the entity, so no depreciation will be allowed. Now, depreciation is to be charged only to the other person. No depreciation will be allowed to you. Cost of acquisition for that matter will be nil. Sir, what if stock is converted into capital asset and used for business and profession? Sir, for example, I have a building. My business is of real estate developer. I develop buildings, flats, and I sell it to outsider. Sir, for example, I sold this building. It was held as capital asset. So I sold 1, 2, 3, 4, 5, 6, 7, 8, 8 flats I sold. Ninth flat I kept it for myself and developed an office. Can I say this stock in trade, which was earlier meant to be sold, is now converted into capital asset? Now this flat will be used for my office premises. Can I say it becomes a depreciable capital asset for me? Depreciable capital asset for me? For that matter, if stock is converted into capital asset and used for business and profession, then FMV on the date of conversion will be cost of acquisition. We have studied that FMV, whatever FMV we are finding out of that on the date of conversion, will be chargeable to tax under PGBP. That means this difference will be chargeable to tax under PGBP, and this cost of acquisition will be considered as cost to be added in block. For this point, FMB on the date of the conversion will be treated as cost that has to be added in the block. This was the basic of converting capital asset into stock in trade. Sir, what if an asset is acquired by the way of gift, will, or inheritance? For example, my father gifted me a building and I used that building for doing my business. So what will be my cost of acquisition? I received that building out by the way of gift. What will be my cost of acquisition? Right answer is, sir, actual cost which was to my father, but it will be allowed as cost of acquisition, and less depreciation that has already been allowed to him. If my father has used such building for his business and he has claimed depreciation, then whatever the value after reducing depreciation will be my cost of acquisition. Or if he has not claimed any depreciation, then whatever cost of acquisition that he had will be allowed to me as cost of acquisition. Any asset, it is not just about building, any plant and machinery that he used to use, and now that he has gifted it to me, whatever cost of acquisition was to him will be cost of acquisition will be cost of acquisition to me. And if he had claimed any depreciation, then cost of acquisition after reducing that depreciation will be cost of acquisition to me. Basic point. Sir, assets sold with an intention to claim a higher depreciation. For example, I have an asset with WDV. Sorry, asset acquired with an aim to claim higher depreciation. So, for example, I bought an asset worth rupees 10 CR and its worth is just 1 CR. I bought asset for rupees 10 CR and its worth is rupees just 1 CR. I just bought that asset just out of the sake to claim excess depreciation. For that matter, what AO will allow, amount determined by AO with the approval of Joint Commissioner will be allowed on such assets. AO will disregard this 10 CR identity and it will allow depreciation on 10 lakh only. Normally, FMV of such asset is considered. For depreciation purpose. So, if you are acquiring any asset with an intention to claim higher depreciation, that value will not be allowed for depreciation. Only the value determined by AO with prior approval of Joint Commissioner will be only allowed. Sir, any reacquisition of sold assets. For example, I had an asset in WDV. WDV was 50 lakh rupees. I sold it to somebody. And sir, reacquired from him again. I reacquired from him again at rupees 75 lakh. Can I say earlier my block was 50 lakh rupees? Earlier my block was 50 lakh rupees and now my block is 75 lakh. Can I say I can claim higher depreciation on this? Can I claim higher depreciation on this? Right answer is, sir, legally you can claim higher depreciation in this case. Because ultimately your block was 50 earlier, you were entitled to depreciation on 50 lakh rupees. Now your block is 75 lakh, you should be entitled to 75 lakh. But provision says if you are acquiring any sold asset, then cost of asset to be added to WDV, will be lower of WDV at the time of sale or reacquisition cost. So WDV at the time of sale is 50 lakhs here and reacquisition cost is 75, whichever is lower. That means the value to be added to block will be 50 lakhs only. Got this point or not? Got this point or not? So what if I don't want an asset, I just want depreciation? I don't want asset, I just want depreciation. What can I do? Sir, can I say, if, for example, I am Rahul and this is a guy, Mayank. Sir, I bought an asset from Mayank. For example, 50 lakhs I bought. And I lent it. I leased it out to Mayank again. What can I say, sir? I am lesser here. Lesser is entitled to claim depreciation. And even I have bought the asset, then too I am allowed to keep depreciation. But right answer is, sir, I don't have any ownership of this property. Ultimately, if you see, this transaction is just a round tripping transaction. There is no essence of this transaction. Ultimately, Mayank was the owner, and right now, even Mayank is the owner. Will I be allowed depreciation? Right answer is I will still be allowed depreciation. Why? Because ultimately, I have paid some money to the Mayank now. I have paid the money to Mayank, and even I am offering income. I am offering lease income also. For that matter, I will be allowed depreciation. But how much? Sir, WTV of the previous owner, sir, whatever was the WTV of the Mayank, that will be my cost of acquisition. And on that cost of acquisition, I will be allowed depreciation. This is a typical case. I want you all to mark star on this point, because whenever you will study this later on, you might get confused. Got this point? Ultimately, what I am doing, I am asking Mayank, I am buying asset from the Mayank and leasing it out to him. What is happening? Essence of the transaction is nothing, because Mayank has lent out asset, sold the asset and reacquired. Sold the asset and reacquired. For Mayank, ultimately transaction means nothing. Ultimately transaction means nothing. But for matter of Rahul, since he has paid some money, so Rahul will be entitled to depreciation on the amount that is WTV to the previous owner, that is WTV to Mayank, will be cost of acquisition for Rahul, and he will be entitled to depreciation. Ultimately, what is the essence? Because Rahul is offering the lease rentals, or he has also paid the amount, he has also paid cost of acquisition. So for that matter, he will be allowed depreciation, but on the value of WTV to the previous owner. So for example, building was used for any other purpose. Now it is brought into business. For example, I had this house. I am using it for residential purpose, and I convert this house for my office premises. For my office premises, can I say that this building was earlier used for personal purpose, and now it is used for commercial purpose or business purpose? Will What will be cost of acquisition of such building? What will be cost of acquisition? Right answer is, take the original cost of acquisition in whatever year it was bought. Take the original cost of acquisition and reduce the notional depreciation as if depreciation were allowed on this building. For example, this building was bought in previous year 13-14. Now, for example, 50 lakh rupees to this building was bought. Reduce depreciation per annum, sir. For example, depreciation allowed on building is 10%. Reduce 10% for 5. Or I should say, depreciation allowed on residential building was nothing but 5%, that is 2.5%, 2.5 lakh. Minus 2.5 lakh. For 10 years, you have to minus as notional depreciation. Whatever the value turns out to be, say 20 lakh. Value turned out to be is 20 lakh. Then this 20 lakh will be your cost of acquisition for your new business. Sir, what if any other asset is brought into any other asset that was used for other purposes brought into business? Sir, if building is transferred, then we have to reduce notional depreciation from the actual cost. But if any other asset is brought into this business, then what to do? So if any other asset is brought into regular business, then original cost of that asset will be considered for calculating cost of acquisition. Sir, all these three cases. Sir, in case asset is transferred between parent 100% holding to subsidiary, asset is being transferred between amalgamated company, or in case of to resulting company, if these assets are being transferred. If assets are being transferred in these cases, what will be depreciation case? Just understand, just focus here what it says. So for example, a company Sai Limited, WTV as on 1st April 2023 was 23 lakh, 25 lakh, or I should say 50 lakh. 15 or 10% rate. Sai Limited amalgamated with Shidi Limited on first October 2023. Sir, and continued as Shidi Limited till 31st March 2024. Can I say this point is valid? Yes, sir, it is valid. How depreciation in this case will be calculated? You have to focus now. Sir, assume Sai Limited would have continued the business, then what amount of depreciation it would have claimed? Calculate that. Sir, if Sai would have continued the business, then depreciation would have been 5 lakh for whole year. Depreciation would have been 5 lakh for a whole year. Provision says divide this 5 lakh into number of days. Number of days this machinery was used by Sai Limited, and number of days machinery was used by Shirdi Limited. For that matter, if I am asked, sir, 183 days is being used by Sai Limited and 182 days is being used by Shirdi Limited, then this 5 lakh depreciation will be divided by 183 into 365. Nearly I can say 2.5 lakh depreciation will be claimed by Sai Limited and 2.5 lakh will be claimed by Shirdi Limited. This is the normal case scenario. This is the normal case scenario. This is how you have to claim the depreciation in case of amalgamation, in case of demerger, and in case of transfer of asset from 100% parent to 100% subsidiary. So now what will be cost of acquisition for Shirdi Limited? Sir, for 50 lakh was cost of acquisition, 50 lakh was WDV for Sai Limited. Reduce depreciation for Sai Limited, then 47.5 lakh rupees will be cost of acquisition for Shirdi Limited, and depreciation allowed in that year will be 2.5 lakh. So ultimately year end WDV for Shirdi Limited will be 45 lakh, and depreciation will continue to be allowed on Shirdi Limited. Understood? What will be cost of acquisition in case of amalgamation? Same case scenario will go for demerger. Same case scenario will go for 100% parent to subsidiary. If you have any doubt in this topic, you can definitely message me. I will reply you personally. Sir, what if asset is acquired out of borrowed fund? Sir, what if asset is acquired out of borrowed fund? What if asset is acquired out of borrowed fund? Sir, if asset is acquired by the borrowed fund, till the date asset is put to use, any interest paid on such borrowed fund will be added to cost of the asset. Till the date asset is put to use, any interest paid on such borrowed funds for the asset will be added to cost of asset, and rest amount will be charged to P&L, and it will be allowed as deduction under section 36. Sir, what if you receive an asset that was used in 3580 business, section 3580 business? Sir, there are those specified business. If you have used those assets for 3580 business and you transfer it to normal business, what will be cost of acquisition? Cost of acquisition is normally nil. Sir, we'll study about this later on. We'll study about this later on in detail. So any GST custom, sir, if you have paid any GST on an asset, if GST ITC is not available, or if customs drawback is not available, for that matter, you will add it to cost if credit is not available. And last but not the least, if you receive any kind of grant or subsidy and it relates to cost of asset, then you have to reduce it from the cost of asset. Got this point or not? If you have received any grant relating to cost of asset, then it will be reduced from cost of asset. Got this point or not? Yes, sir, we did understand what you are saying. We did understand. This is how you have to calculate cost of acquisition. In normal cases, we studied, and in special cases, we also studied. Now, other points. Sir, we have studied 5 points till now in depreciation. First of all, sir, what were the depreciation rates? Second thing, how to calculate depreciation. How to calculate depreciation in case of capital gain. How to calculate capital gain. Fourth one was additional depreciation, and fifth one was cost of acquisition. Now we have other points. How other points are dealt in depreciation? Sir, what other points do you mean? Sir, what if asset is partly used for business purpose and partly for personal purpose? Is it possible to use asset for partly for business purpose and partly for personal purpose? Yes, sir. If you are having any car, it will partly for business purpose and partly for other purpose. For business hours, you are using it for business, and for Sundays, you are using it for personal purpose. Sir, is it possible? Yes, sir, it is possible. Then depreciation will be allowed only for business purpose. For example, if asset is having WDV of rupees 10 lakh and depreciation rate is 15 lakh, and 50% is used for business purpose and 50% for personal purpose. So how did you arrive at this 50%? Always given in question. You are solving ICI paper. Question given in question. How depreciation will be calculated? Calculate depreciation on total. For example, on 10 lakh asset, 15% depreciation amounts to 1,50,000. Since 50% amounts to business depreciation and rest 50% in personal, only 75,000 depreciation will be allowed as WDV, and it will be reduced from WTV. Hold this point number 2 for some time. We'll study this later. There was another point, na, we did leave? There was another point we did leave. What was that? Okay, yes. So what if an asset is purchased in foreign credit? For example, focus here. Focus here, what here says. For example, I bought asset on 1st Jan 2024 for $10,000. At that time, rupee is equals to $1 was is equals to 80 rupees. And I bought on credit. I was required to pay till 31st March 2024. I was given credit for 3 months and I bought that asset for credit. As soon as I bought the asset, I used it. I started using it. I was eligible for depreciation. Sir, I added certain cost to WDV. Sir, for example, I added cost to WDV. So simply 10,000 into 80 is equals to 8 lakh. 8 lakh I added to cost of acquisition and WDV respectively. 8 lakh was cost of acquisition and I added such cost of acquisition to WDV. Sir, while when I was approaching the payment date, and when I ordered bank to pay rupees $10,000, bank asked me rupees 82 per dollar. Rupees 82 per dollar. Sir, I was required to pay 8,20,000 rupees. I had capitalized asset of rupees 8 lakh and I am required to pay 8,20,000. Sir, what will be the treatment of this increased amount? Sir, this difference of 20,000 that is on account of foreign exchange fluctuations. How will we deal such difference? How will we deal such difference? How will we deal such difference? Right answer is sir, any such difference, any such loss will be added, or if there is any gain, it will be reduced from block itself. If gain or loss is on account of any depreciable asset, it will be adjusted from block only. It will not be transferred to P&L. Hope the concept that I am trying to convey from this topic is clear. Profit and loss due to foreign exchange fluctuations at the time of the payment shall be adjusted from cost of asset, including hedging contracts. If there is any loss or any profit, added to cost and reduced from the cost of the asset. If there is loss, add to cost of the asset. If any profit, then reduce it to the cost of asset. Depreciation in case of amalgamation, demerger, succession. What this provision says, sir, in case of depreciation, in these cases depreciation is calculated normally. Sir, normally, as I told you, sir, Sai Limited, for whatever the value was 50 lakh, normal calculate 10% depreciation for a year, and then after that allocated between two entities in the ratio of number of days used by such assets. For example, sir, 183 days were used by Sai Limited and 182 days were used by Sheedy Limited, each entity. For the asset acquired in mid of the year, allocation shall be made in the asset used by number of days by each entity. For example, asset was acquired on sir 1st October only. Then how many days sir old entity would have used? Sir, since acquisition amalgamation was on this date, that means old entity have not used this asset. All old entity must have not used this asset. Then complete depreciation will be allowed to new entity. That means you have to catch the date of acquisition, and based on that date of acquisition, you have to allocate it between number of days used by old entity and new entity. This is how you have to calculate depreciation in case of amalgamation and succession. So depreciation in case of power generating unit and power distributing unit. Sir, we have studied, sir, power generating unit and distribution unit have an option either to go with WTV method and follow block of asset system as we have discussed earlier, but they can also opt for SLM method and individual asset system. Each asset is to be accounted individually and no additional depreciation will be allowed. How, sir, depreciation will be calculated in that case? How, sir, depreciation will be calculated in that case? Right answer is the depreciation will be calculated as normal. So, for example, asset is bought at rupees 1,000 and useful life is expected to be 10. Useful life is to be expected 10 years. And sir, no scrap is expected. Sir, how much depreciation per annum we have to charge? Sir, 1,000 divided by 10 is nothing but 100 rupees depreciation we have to charge per annum. As how a thing simpler can this be? How a thing can be simpler than this? You have to use SLM method. For each and every asset, you have to follow SLM method, like you do in Companies Act. What else you want? Simply this is to be done. But but sir, capital gain treatment will be different. Capital gain different treatment will be different. For example, I bought an asset for rupees 1000, previous year 1/4/2022. Depreciation rupees 100 for previous year 22/23, and value on 1/4/2023 turns out to be 900. I sold such asset. I sold such asset, sir. For example, sir, I sold such asset for 700 rupees. I sold such asset for 700 rupees. Sir, my cost was 1000. My WTV was 900. So normally profit and loss is calculated from WTV. Sir, if my WTV is 900 and I am selling such asset at 700, and I say I am doing loss of 200. Already, sir, I am having WTV 900. Sir, loss of 200. Sir, can I say loss? Right answer is yes, sir. It is. It will be a loss of 200 and it will be allowed. It will be an allowed expenditure. Sir, what if I sell such asset for 950 rupees? What if I sell such asset for 950 rupees? Sir, simple thought. So 1000 rupees cost, 900 rupees WTV. We have to calculate gain or loss from WTV. Can I say 50 rupees gain I am occurring? I am having 50 rupees gain because I am selling at a price higher than this WTV. I am selling at a price higher than this WTV. Can I say 50 rupees will be gain and that shall be taxable under head PGBP? Yes, sir, it will be completely taxable. Sir, what if I sold this asset for 1200 rupees? Sir, this has to be taken with due care. What I am saying. Sir, cost was 1000, WTV was 900. Sir, I am selling this asset for 1200 rupees. I am selling this asset for 1200 rupees. Sir, focus. Sir, from WTV till cost of acquisition, whatever the gain I am having will be chargeable to head PGP, and from cost of acquisition till the actual sales, gain will be under the head capital gain. Sir, why I am doing this? Just focus. Sir, I am selling for 1200 and WTV is 900. Sir, from 900 to 1000, difference rupees 100 will be chargeable to head PGBP, and 1200 minus 1000 will be chargeable to 200 will be chargeable to capital gain. Can I say these two things? First of all, I want you all to learn this point because I will be telling you logic later on. I will be telling you logic later on. Sir, 100 rupees capital gain. That means gain from WTV till cost of acquisition will be chargeable under PGBP, and gain from cost of acquisition over and above cost of acquisition till the actual sales will be chargeable to capital gain. Sir, why we are bifurcating this? Listen, there are two reasons for this. First of all, it is capital asset. Any plant and machinery is a capital asset. Any gain should be chargeable under that capital gain only. So then why we are using PGBP? Because you have claimed a depreciation under the head PGBP. Can I say in this point, sir, sale of 1200, out of the sale 100 or sale of 1200, gain of rupees 100, that is from WTV till actual cost of acquisition. From WTV till actual cost of acquisition, this amount of 100 rupees gain is already debited to P&L in prior year in the name of depreciation. Can I say you have already claimed depreciation on such asset, or this amount of depreciation you have already claimed in PGP? Therefore, up to the level of this gain will be chargeable in capital gain, and balance will be charged in capital. Up to this amount, up to this gain of 100 rupees will be chargeable in PGP because you have claimed depreciation up to this amount, and balance will be chargeable under that capital gain. Can I say that point? Yes, sir. Because you have claimed a depreciation now on that assets. And to the extent the expense was charged to P&L, that income should also be charged to P&L. For that matter, gain from WTV to cost will be chargeable to P&L, and balance above cost will be chargeable to capital gain. This is how the thumb rule works. Sir, 200 loss allowed, 50 gain allowed. Sir, 1200. Sir, gain up to 100 is taxable under PGP, gain up to 200 is short-term capital gain. I hope things are very much clear to you. Last but not the least. Sir, for example, I have depreciation. I have claimed a depreciation. For example, I have claimed a depreciation Claimed depreciation. For example, my profit for previous year 22-23 was, sir, EBITDA, profit before charging taxes, interest, depreciation was, for example, 100 cr. My depreciation for the year was 150 cr. Sir, I have also brought forward losses. I have brought forward losses, for example, 50 lakh rupees. 50 cr I have losses. No, not 50 cr. Assume it. Brought forward losses of 20 cr. Sir, can I say I have profit of 100 cr, depreciation on 150 cr? Can I say that 50 crores of depreciation is not absorbed? 50 crore of depreciation is not absorbed because my profit is not sufficient to absorb the depreciation of 50 crore. So can I say this 50 cr depreciation is unabsorbed depreciation? This is the unabsorbed depreciation only. There is nothing, there is no other concept. Unabsorbed depreciation means a depreciation that cannot be absorbed because insufficiency of profit. Sir, for example, what happens? I have a gain of, for example, 200 cr, not 200 cr, a gain of rupees, yes, sir, 200 cr. Current year depreciation turns out to be, for example, current year depreciation turns out to be 60 cr, 140 cr. 140 cr current year depreciation turns out to be. Sir, my profit turns out to be 60 cr. Now, this profit, against this profit, I can use this brought forward depreciation or I can use this unabsorbed depreciation also. Sir, against this profit of 60 cr, against this profit of 60 cr, I can set off this brought forward losses. I can set off this unabsorbed depreciation. What will be the sequence of set off? Right answer is, first of all, you have to set off the brought forward depreciation, brought forward losses. So 20 cr is to be set off first, because sir, because brought forward losses can be carried forward to 8 years only, but unabsorbed depreciation can be carried forward indefinitely. So for example, in this case, we have set off 20 cr of brought forward losses and balance 40 cr of unabsorbed depreciation. So our profit turns out to be zero, and our still carry forward losses, still carry forward depreciation would be 10 cr. Got this point or not? This 10 cr would be our carry forward depreciation. Read this along with me. Profit before charging depreciation as per Income Tax Act. Depreciation as per Income Tax Act. If depreciation is much more than profit chargeable to tax, then whatever amount of depreciation turns out to be will be unabsorbed depreciation. Unabsorbed depreciation can be carried forward indefinitely, sir. For indefinite period, you can carry forward unabsorbed depreciation. It can be set off against any head, sir. You can set off it against capital gain head. You can set off against IFRS. You can set off against salary. No, sir. No, you cannot set off against salary. It can set off against any head except salary. Sir, order of set off. First of all, current year depreciation has to be reduced the way we did. Sir, then brought forward business loss the way we did, and the last unabsorbed depreciation the way we did. Last but not the least, it can be set off against the business income to which such unabsorbed depreciation does not relate to. For example, if I had opened a business, for example, business of shoes, I'm already having business of garments and I have opened a new business of footwear. I have bought too much of machineries, sir. Because of too much of machineries, I have too much of depreciation in this business. I have too much of unabsorbed depreciation turning out to be in this business. Can I set off this unabsorbed depreciation from my apparel business or garment business? Right answer is yes, you can do so. Unabsorbed depreciation can be set off against different businesses also, that from which such depreciation does not even pertain to. Which means simply, if I have unabsorbed depreciation in footwear business, I can set off this unabsorbed depreciation from my garment business as well. This was the concept of unabsorbed depreciation. Hope you understood this topic of depreciation. With that, I have completed the topic depreciation till now. Tomorrow we will be studying PGBP in depth. I want your focus to the fullest extent from tomorrow onwards. This class will be on YouTube. If you want to refer this class as many times, you can refer as many times as you want to. But focus now, things to be taken care of, things that are to be taken care of from your end. We have completed chapter capital gain. We have completed chapter IFOS. You have to solve question answers of those chapters. If you have any doubt in question answers, you can refer my YouTube video. I have solved each and every question of question answers. It is in Hindi, but you will understand. Second thing, we have studied PGBP today. I want all of you to clear your backlog till now, because if you will not complete capital gain today, it is rarely possible that you will be able to complete PGBP's question answers along with me, because most probably PGBP will be ending up tomorrow. but you will find difficulty in solving questions of easy PP. So for that matter, you have to complete your backlog today. You have to clear your backlog today. Hope you are enjoying these sessions because I am enjoying. If you have any doubt, feel free to ask me. I'll be there for you. If you have any doubt relating anything other than subject, I'll be there for you. My number is in description box. You can anytime contact me. Last but not the least, you have to enjoy studying because this is the most beautiful subject of CA final. No subject is as beautiful as direct taxation because it is very much relevant. You cannot think of an aspect that is not relevant for real life. It is very much relevant, very much prevalent, and very much interesting. So see you guys tomorrow with same energy, same enthusiasm, and same spirit tomorrow morning.